Hi, good afternoon to all. I welcome everyone on the panel here, and I also welcome all the participants to the special program on oil and gas. All credit to C. Drushti Desai, Chairperson for Members in Industry and Business Committee of WIRC, and Chairman of WIRCC Lalit Bajaj, for leading from the front. Every month we pick up one industry, we do a forum, and we already done pharma and then real estate, oil and gas, and now next we are planning infrastructure. And then the forum, whatever inputs we get, on the basis of that we make representations regarding direct tax, indirect tax, and then we even go on to do these type of an industry specific program. So I welcome all of you to this. Let me welcome today's first learned speaker, Mr. Anand Vishwanathan. Anand is going to talk us through about the oil and gas industry landscape. Welcome, Anand. Then let me also welcome C. Anuj Agarwal. Anuj is going to cover the direct tax implication on the oil and gas industry. Anuj, welcome.
Thank you.
I also welcome Sujaya. As we go into the panel, she is going to be moderating the panel and she is going to be extracting a lot of information from all the four panelists.
Thank you.
Panelists, we
Thank
have
you, sir.
Vineet. Yes, Vineet is with Shell, and Vineet is one of the panelists and is going to cover a lot of his experience. He's going to share with us. Welcome, Vineet.
Yeah, thanks, Amartya.
Yes, I also recognize presence of CA Rajesh Shah, coordinator for today's program. With that, let me request chairperson of Committee of Members in Industry, Drushti, for her opening remarks. Drushti, man, over to you.
Thank you, Murtaza bhai, for organizing this wonderful program today. I would give you 200% credit for today's program. Excellent program, and it is focused, very focused program. So we have been doing under this committee for members in business and industry, sector-specific programs, and then there's also a request from the participants who are players in the sectors, the specific sectors, that we should have sector-specific programs which will touch upon the technical aspects, so that can also go to help the members who are working in those specific sectors, or even those who are in practice. They also can really benefit in rendering their services. So that is the focus of the programs that we organize under this. Now, apart from this, we are at WRC. I would also like to update you on another initiative that we have started off with, which is looking at the way things are and everything is going digital. We have this time, for the first time at WRC, we have launched our referencer also in a digital format on a subscription model. So anybody who wants to access the WRC referencer, which has been, which is an effort put in by so many professionals who have selflessly devoted time and given their input. So if anybody wants to access, can just go on to WRC website and you'll be able to access it by paying a very small subscription, and it will be available for a year. So that's one update that I want to give. The second thing is that we are also coming up with a very unique program under the guidance of our chairman, Lalit Bajaj, where that is focused on directors, so directorship and independent directors. So it is by the name of independent directors masterclass, and that would give us an idea about what are the roles, responsibilities, how conflicts can be resolved, and we have excellent panelists in the program. It is a 3-day program, and we'll have several sessions, preliminaries from the directors. I would say from directors have joined this program, and they will be addressing the members. So it will be a very good learning for our members who would want to look at this option of taking up independent directorship also. It will be a good learning for members. So this is another thing which you can look at. So I think that those are some of the updates that are from my side. I would now hand it over to Murtaza Bhai, over to you, Murtaza Bhai, to take the proceedings forward. Thank you.
Thank you, Drishti, for all the inputs. Now I request Chairman WRC CA Lalit Bajaj for his opening remarks and inputs. Chairman, over to you.
Thanks, Murtuja bhai. Mr. Anand Vishwanath, CA Anuj Agarwal, Moderator Sujaya Dash, Panelists Ashish Jain, Maqbool Moosa, Raj Mullick, Vineet Kishor, Coordinator Rajesh Shah, my co-regional council members Murtuja Kachwala, Secretary WIRC, and Drishti Desai, Chairman CMII Committee. Seniors, friends and colleagues, on behalf of WIRC, I welcome all of you in this gathering wherein we are going to share some of the insights and some of the inputs related to oil and gas industry. Friends, let me tell all of you that at WIRC this year we had endeavor with us of creating competence, and that too with innovative means. And I am very much fortunate with the help of all my regional council members. We have been really able to come out with some of the very innovative ideas, as Drishti has already spoken. And with the inputs getting from all the members, we will really try to ensure that we can do best for the benefit of members and students. As far as this particular webinar is concerned, this is one of the initiative wherein we are trying to ensure various programs related to industry, and hopefully in the coming months we have lined up 7-8 industries on which we will be having interaction meet, and at the same time subsequently we will be submitting various representations and will be planning various conferences. So I would like to just impress upon the participants today that if you feel so that there is any particular industry wherein you would like to really come out with some area wherein we need to represent or we need to share some thoughts, so please write to us at wirc@ici.in, because our committee of members in industry is working very hard, and with help and insight from all of you, it will really help us to serve better. Friends, I would like to share with you that we have started with a research forum, as this year it was one of the action plan of WIRC of making research as one of the pivotal activity. And we have started with the research forum wherein many members have shown their interest, and we have shortlisted subjects, we are forming groups, and we will be coming out with some research material for the benefit of members at large. Again, in this initiative, if any member is interested, please come ahead and write to us. Friends, at WIRC, for the benefit of members in practice and especially small and medium practitioners, we have come out with some basic tools which can really be used by the members working in industry. There are 7 tools which we have uploaded on WIRC website, and I am happy to share with all of you that we have tried to cover all the areas of our profession proportionately in the various tools, whether it is direct tax, indirect tax, management consultancy, or assurance services. So I would request all of you, please visit the WIRC website, and wherever you feel that those tools can really be helpful to you in deciding and understanding the various figures and facts, I think so we will really be able to put across some more inputs related to that. We have given a helpline number for every tool, so that if there is any confusion or any doubt, you can contact the respective member and understand with him what is the tool and how can you address the particular doubt. So once again, I welcome all of you in this August gathering, and I look forward for more participation and more contribution for all of you in all the activities and initiatives of WIRC, so that we can move ahead with our action plan for this year. Thank you participants for being with us. Thank you. Back to Murtuza.
Thank you, Chairman, for your inputs and all the updates. Friends, let us now move straight to the sessions. And we have two expert speakers, Anand Vishwanathan and Anuj Agarwal. I will introduce both of them together initially. Then Anand will start. Anand will talk us through about the landscape of oil and gas, and then he will hand over to Anuj. Anuj will cover the direct aspects. And as we go through the session, whatever questions you have, you can type in the chat box. At the back end, we'll keep on looking at the questions. And when Anuj finishes, we'll again request both of them to come on board so that we can put your questions to them. They will answer it, and then we'll move into the panel. So with that, let me first take the privilege to introduce Anand. Anand Vishwanathan is currently Senior Manager with Productivity India and in the internet space. Before this, he's worked with EY for 3.5 years and Schlumberger for 4 years. Anand is an MBA from Great Lakes Institute of Management, India. He is MSc Geology, St. Xavier's College, and is BSc Geology, St. Xavier's College. Anand's industry expertise is oil and gas, manufacturing, chemical. And Anand is an expert in internal control, business process review, E&P operations, and plant maintenance. Initially in his career, he's provided consulting services to clients by analyzing real-time data based on well status, drilling performance, reservoir fluid composition, and lithology that helped in drilling more efficiently, identified productive hydrocarbon-bearing formations and co-relatable geological formations, and provide data to the driller that enables safe and optimized operations. Worked with some of the largest oil and gas companies like Total, Shell, GDF, Swiss, Qatar Petroleum, Qatar Gas, British Petroleum, etc., and UAE, Qatar, Iraq, and Brunei. Currently, Anand is managing a team of consultants and is providing internet services to large oil and gas, integrated oil and gas companies. He is also handles the internet function for the client's E&P business, which involves periodic risk assessment, preparation of annual audit plan, GRC automation, managing SAP-based audit management system, and conducting risk-based audits. Anand has also carried out process reviews for India's largest peroxide manufacturing company plant expansion, and he has conducted various risk-based integration, procurement, and contract audits, and he's also been involved in SOX testing assignment. With that, let us welcome Anand. Anand, welcome.
Thank you, Mr.
Let me then take the privilege of introducing Anuj. Anuj Agarwal is Director, Global Business Tax. Anuj is with Deloitte, Tosh Tomasho India LLP, and is based at Gurgaon. With specialization in corporate and international tax, Anuj has significant experience in advising multinationals on a wide range of matters, including international taxation, transaction tax, and exchange control. From industry specialization standpoint, Anuj has advised various multinational and domestic companies in the entire value chain of energy sector, including oil and gas, power, LNG, etc., on transaction structuring, funding mechanics, and dispute resolution. In EPC sphere, Anuj has experience in advising clients on bid planning and review, alternate EPC contracting structures, and advising on optimal tax structures. Anuj has also advised clients in aerospace and defense and manufacturing sector. He's helped a number of clients on their country entry strategy, optimal investment jurisdiction analysis, funding mechanics, and efficient cash repatriation and exit planning. He's also undertaken strategic tax review for clients to optimize their effective tax rate in India. Anuj has co-authored several publications published by Forbes, International Taxation Taxman, Leading Business Diaries, etc. For the past few years, Anuj has been contributing chapters on oil and gas and power sector for European Business Group and co-presenting pre-budget recommendations to the Ministry of Finance on behalf of EBG. Anuj is a graduate in commerce from Shriram College of Commerce, Delhi University, and a meritorious member of the Institute of Chartered Accountants of India. Let us also welcome Anuj. Anuj, welcome to this forum.
Thank you, sir.
With that, I hand over charge to Anand. Anand, over to you. You can take charge of the session, share your slides, and over to you, Anand.
Thank you, Murtaza. Can you let me know if you can see my slide?
Not yet. I think you'll have to share.
Yeah.
Yes, we can.
All right.
Anand, if you can put them in the presentation mode.
Yes, I'll do that.
Great.
All right. So let me just remove this. Yeah. All right. Thanks a lot, Murtaza, for this wonderful introduction and this great opportunity. As Murtaza mentioned, I will be taking you through the overview of I will be taking you through the overview of the oil and gas industry landscape, and I'll be starting with some technical bit. But as I move on, I'll talk about the industry trends as of today. So first, we'll be discussing the different segments of the industry, each of which involves extremely different processes or operations. So if you can see in this picture, it shows the three different segments of the oil and gas industry and the flow between each of them. It starts with the upstream sector, which refers to anything having to do with the exploration and production of oil and gas. The upstream sector involves geological surveys and other information gathering methods used to locate areas where hydrocarbon is likely to be found. The upstream sector also involves the processes to actually drill the well and get the hydrocarbon like crude oil and gas to the surface of the earth. This process is called production. The next segment is midstream. The midstream segment of oil and gas refers to processes involving transportation and storage of oil and gas before they are refined and processed into different elements which we use in our day-to-day lives. So midstream includes pipelines and the infrastructure related to pipelines and transportation of crude and gas to individual consumers. It involves tanks. It involves maybe even purifications and rails and shipment. The last segment would be downstream. So this includes everything involving the turning of crude and natural gas into multiple finished products we depend on every day. Some of the common products include fuels like petrol, kerosene, jet fuels, or even tar, which is used for building roads. We'll be talking more about this in the upcoming slides. Yeah. So now I'll be talking more about the sub-segments or the processes in each of these segments I discussed earlier. The first segment, upstream, involves multiple processes of varied natures, like I've listed down over here. The first process is called block acquisition. So this is an entire elaborate process involving buying the initial survey data from the government and bidding for the block to explore for the natural gas and oil. We'll be talking more about the procurement of the block and the bidding for block in probably further down the slides. The next process is called seismic survey. So this is extremely technical, where people like geologists and geophysicists are involved. This process is initially done by the Geological Survey of India, and the data and the oil companies need to procure data from them. The process can also be carried out by these companies prior to drilling and exploring for oil and gas. So the initial data that they receive from the government, if they feel it's not right, they do their own exploration, they do their own seismic surveys and fill in the gaps. So this process is done basically to explore for oil and gas, to know where the reserves are located, and to know the extent of the same, to know how much hydrocarbon is present in the earth. So a seismic survey is conducted by creating a shock wave or a seismic wave on the surface of the ground. This wave, which is created, travels down to the earth and is reflected back by the subsurface formations. Like if there's water, it has a different speed. If it's gas, it has a different speed. If it's oil, it's got a different speed. So when it returns, it's recorded by geophones, and based on the recordings, the geophysicist can map exactly what is present under the earth. So this process, by analyzing the time it takes for the seismic waves to reflect off the different subsurface formation and return to the surface, a geophysicist predicts how much oil or gas is trapped in there. So this doesn't necessarily mean that you can extract that oil. It just says that maybe this much oil is present. So the next process is the drilling of the exploratory well. So once the seismic survey data is received and analyzed, the exploratory wells are drilled. An exploratory well is a deep test hole drilled by the oil and gas exploration company to locate the exact, to actually explore for the oil or gas which is present under the earth. Areas are first identified, like I mentioned, through the seismic data, post which these wells are drilled. The next process involves the drilling of appraisal wells. So similar to exploratory wells, appraisal wells are not producing wells, but they're drilled to explore the subsurface formation. The area or the basin length and breadth of the basin is determined through these appraisal wells. So multiple wells are drilled in different locations in the field, and with the data recorded, they finalize the length and the breadth of the well of the oil reservoir. So the next process of drilling is called the developmental well. So a developmental well is drilled in a proven producing area for the production of oil or gas. Dry or unsuccessful development wells are pretty rare compared to dry exploratory wells. This is mainly due to multiple exploratory and appraisal wells which are previously already drilled and researched. So as of today, because of the technological advancements, and it's made possible to drill curved and horizontal wells as well, which helps in increasing the output by exploring more and more surface area of the reservoir. The next process is called well completion. So once a well is drilled, a developmental well is drilled, it needs to be completed. It needs to be there are multiple processes which are like called casing, cementing, perforation. The last process probably is called the installation of a Christmas tree. A Christmas tree helps to maintain the pressure inside the well so that the flow is controlled. The next process is called production. This is actually getting the oil or gas within the earth onto the surface. It involves a lot of pressure control processes which are needed to be followed throughout the lifetime of the well. Yeah. So the next process is called abandonment. So once the oil or gas is depleted, or the quantity is not feasible to be produced, the well needs to be abandoned, or maybe it can also be called plugged. So what this involves is placing multiple cement plugs inside the well, so that each kind of formation, the gas formations, the oil formations, the water formations are bifurcated and plugged so that it doesn't come out to the surface, and the pressures are also maintained inside the well. So this concludes the upstream segment of the oil and gas industry. Next, we move on to the midstream segment. The midstream involves, like I mentioned earlier, it involves carrying the different products like oil and gas to the consumers, and it involves laying of mostly through pipelines. So the first process is for laying the pipeline would be the route survey. As the name suggests, it involves surveying, it's the studying and finalizing the path to laying the pipeline. So the next process is called land acquisition. Also, like the name suggests, once the pipeline path has been finalized, you need to liaise in with the government and start acquiring land, and also not only from the government, also from the landowners, farmers, whoever come in the path, right? So this process also involves a lot of liaising. So the next process is once the land is acquired, the next process is to clear the land of whatever vegetation or whatever's involved in the path, whatever covers the path. The process involves removal of vegetation and also involves flattening of the land to clear the path for the laying of the pipeline. So this process would also require licensing because it involves a lot of permits, which is required to maybe remove the vegetation. All right. So moving ahead, the next phase is actually laying the pipeline. So for offshore, there is a pipe laying vessel which is used, in which the string of pipeline, the individual pipes are stringed together, welded together, and wherever there's a bending required, they bend it, and then they are tested and they are laid down into in the ocean. Lastly, once the pipeline has been laid, it has to be regularly maintained as per the OEM's instruction, and there needs to be a proper plan in place for the maintenance. Next, we move on to the downstream sector. So downstream sector, like I discussed earlier, is more about refining and also involves petrochemicals and everything. The first process for the downstream industry would be sourcing for the oil and gas. So sourcing for the crude oil and the gas. So sourcing for crude oil, it requires, like, depending on the refining margins, they need to have a proper procurement strategy. So the world crude oil market includes a lot of spot markets and featuring physical transactions, but it also involves like a highly developed futures and forward delivery. So this market, it's a very complex kind of a market structure. So once the crude oil is sourced through the different sourcing strategies, it needs to be purified. So purification is something which can also be considered as a midstream process, specifically when you talk about natural gas. So because natural gas, when it's extracted, it contains a lot of moisture, sulfur, which needs to be extracted before it's sent out for further processing. So basically, this purification process removes, like I mentioned, the contaminants and the sulfur from the oil and as well as gas. The next process involves separation. So this is a highly technical kind of a process, which involves piping crude oil through hot furnaces. So once this is done, the resulting liquid and vapors are discharged into distillation units. Inside the units, the liquid and vapors separate into different petroleum components, which are called fractions. So based on the boiling points of each of these fractions, they settle. Maybe so the heavier fractions settle down at the bottom of the distillation unit, and the lighter fraction move on top. So the lightest fraction, which includes petrol and liquefied petroleum gas, vaporizes quickly and rise to the top of the distillation tower. There they condensate back into liquids, and which is collected and maybe purified in the next stage. So the medium weight fractions, those get collected in the middle section of the distillation tower, and then the heavier fractions are settled at the bottom, and which are extracted from the bottom. Once this is done, the next process would involve conversion. So after distillation, heavy and lower value distillation fractions can be processed further into lighter and heavier value products such as petrol. So to do this, the fractions are transformed into streams that eventually become finished products. So the most commonly used conversion factor is called cracking. I'm sure all of you all would have already heard about this. And the other processes involves splitting of these molecules into different lighter molecules. The next process after cracking or after conversion is called treatment. The finishing touches occur during the final treatment. So to make petrol, maybe the technicians combine a variety of streams from different processing units. The temperature, based on the temperature, vapor, the pressure ratings, the different blends of for example, petrol is made. All right, so this all involved the crude oil processing. Next, we go on to petrochemicals. So petrochemicals are derived from various chemical compounds, mainly from hydrocarbons. So these hydrocarbons are derived from, like I mentioned earlier, from crude oil. Among the various fractions produced by distillation of crude oil, petroleum gases, naphtha, kerosene, and gas oils are the main feedstock for petrochemical plants. These feedstock, based on a lot of combinations and catalysts, they are transformed into a lot of different varieties of petrochemicals, which are used for producing uh, like thousands of different products which we use in our day-to-day lives. The last process over here would be distribution. So petroleum products and petrochemicals are distributed using various channels based on the product type. So if it's a solid, it will require a very different channel of distribution compared to a liquid, which can be transported through pipelines. So yeah, so basically we use like trucks, ships, and pipelines to distribute these products. Yeah, so next we will be discussing about the oil and gas statistics. So all oil and gas reserve estimations involve some degree of uncertainties, like I mentioned earlier. The uncertainty depends majorly on the amount of reliable geological data and seismic data at the time of estimation and the interpretation of these data. Based on the degree of uncertainty, reserves are classified into basically three categories. There are many theories, but this is the most widely used theory. This three categories called proved, probable, and possible. So proved reserves are those quantities of petrochemical which by analysis of geological and engineering data can be estimated with reasonable certainty to be commercially producible. So this is something which world over we can say that this much oil is present as on today. That's called proved reserves. The next one is called probable reserves. So these are unproved reserves for which analysis of geological and engineering data suggests that they are more likely than not to be recoverable. Meaning, maybe around 50%. There's a 50% probability that these quantities are actually recoverable due to the technological advancements required. The final category is called possible reserves. So this is again based on geological and engineering data. It suggests it's highly unlikely that this can be recovered based on today's technology, and there's like maybe 10% probability that this can be extracted. So next, based on these categories, the world oil reserves are estimated. Next, we talk about world oil reserves. So after so many years of research, since the first modern discovery of crude oil was made, I think in 1850s or something, it is still impossible to predict with 100% accuracy that the quantum of oil or gas present within the earth. Or for that matter, how much is producible from the discoveries which has already been made. This graph here shows us how much oil reserves have been discovered using the exploratory methods discussed above. This does not mean that these reserves are extractable. Like I mentioned earlier, these are just the estimates. These are not 100%. You can't say for a fact that this much oil can be extracted. The graph clearly shows us the time, as time progresses, the reserves have increased. So this is mainly due to technological advancements that we have reached at as on today. So as per this graph, we can see Middle East has the maximum reserves as on 2020. However, do note that some of the untapped hydrocarbon reservoirs, for example, in the Arctic or the Antarctic belt or the Greenland belt, has not been included in this. So next we talk about oil production. Here you can see the production of oil and gas per region. Again, it's very clear that Middle East has the maximum oil production as on 2020. Even though, as per the latest uh, researchers, Venezuela is supposed to have the highest oil reserves, followed by Saudi and Canada. This is mainly because oil deposits in the Middle East are comparatively very easy to recover as compared to Venezuela or Canada, where the extraction, although is possible, is expensive and not sustainable and at the price of oil as on today. Also, you can observe an increase in the North American production in the recent past. So this is mainly attributed to the boom in American shale oil, which more recently has seen a downfall because of the oil price. So here we talk about consumption. Crude oil consumption has been increasing rapidly over the past lot of years. As of 2019, two of the top three petroleum consuming countries were from Asia. Uh, that includes China, which consumes 14% of the world total, and also India, which consumes 4% of the world total. At the top of the list is again USA with a consumption of 20% of the world total. So oil consumption, as you can see clearly over here, has grown by around 0.9 million barrels per day between 2019 and 20. So as the economies of countries like Brazil, Russia, India, China become richer and their economies expand, their need for crude increase more and more. So next is about oil and gas production. This is about gas production. So global demand for gas has more than doubled in the past 30 years. Gas production has grown by around 132 billion cubic meters, outpacing its consumption norms. The US accounted for the two-thirds of this growth. This is mostly attributed to the shale gas, the coal bed methane that they've been exploiting in the US. So natural gas supply was also boosted by a strong growth in Australia and China. So the gas generation, the power generation sector is the principal consumer of gas in most regions, challenged only by the manufacturing sectors of India, China, and the developing countries in Latin America like Brazil and Argentina. Here you can see the top 5 oil producing countries. So US in US you can see in the graph that it's grown tremendously at around 1.2 million barrels per day in 2019. In 2019 they took over Russia to be the highest producer in the world. Cumulatively, US, Russia, and Saudi produces around 40% of the world's oil. And also the OPEC countries, the Organization of Petroleum countries, together contributed 38% of the world's oil. Let's talk about the Indian oil and gas industry. So over here, the first graph to the top left shows India's crude oil reserves. So India holds around 4,728 million barrels of proven oil reserves as on 2016. This was like, so India was ranked 24th in the world, and it accounted to about 0.3 of the world's total oil reserves, which is very minuscule. So India's proven reserves of about India has a proven reserve of about 2.9 times its annual consumption, which means if we do not import any oil, we can last for just 3 years with the current rate of our consumption. The next graph on the top right is about India's oil demand. So India was the third largest India was the third largest energy consumer in the world after China and the United States in 2018. So according to BP's latest reviews, India's need for energy supply continues to climb as a result of its continuous growth, economic growth, population growth, and modernization. The gap between India's oil demand and supply is continuously widening, as you can see from these graphs. Demand for crude oil in 2019 had reached 4.9 billion barrels per day. But as per, if you can see the first graph, you can see or maybe the next graph, you can see that the production is not as much as what we are demanding. Next, we talk about India's crude oil production. So as of 2019, India had approximately 5 million barrels per day of refining capacity. This made India the second largest refiner in the entire of Asia, following China. The two largest refineries by crude oil capacity were both located in Jamnagar, and the third largest was again in Gujarat, in a place called Vadinar. The Jamnagar refinery accounts for around 27% of India's current capacity. So next, like I mentioned earlier, we'll be talking about the different crude oil products. Although countries have started investing more and more in cleaner fuels, we still depend on oil for a lot of other products that we use in our day-to-day lives. So here you can see the details of what a barrel of oil yields. So as and when refining methods are constantly being improved, a variety of complex what you call operations are now used, which have improved their output. So refineries today turn approximately half of every barrel of crude into petrol. This is like a really big advance from what it was around maybe 70 years back, when only 25% of the entire barrel was could be converted to petrol. And yeah, so some of the primary products extracted from a barrel of crude includes, for example, petrol, which, like I mentioned, would be around 45 to 50%. It includes diesel, which would be around 20 to 25%. Kerosene, jet fuel, which makes up around 9%. Hydrocarbon gas liquids, again 4%, around 4%, and then heating oil, residual fuels, and others, which makes up the entire barrel. So roughly, there's an estimated 6,000 variety of products that is made from crude oil. So even like I said, if crude oil gets over tomorrow, it's not only affecting our energy consumption pattern, but a day-to-day toothbrush, which is made from crude oil, we need to find a replacement for that as well. So we really need to start looking out for alternatives for all of these crude oil and gas that we are consuming. So some of the examples I can give is soaps, glasses, contact lenses, food preservatives, crayons, medicines, wheels, shoe polishes, inks, fertilizers. There are 6,000 of these, and the list keeps going on. So next, let me take you deeper into how India's oil and gas sector is doing. So yeah, so India's crude oil imports had reached 4.4 billion barrels per day in 2019, where Iraq, with a share of 22%, had become one of India's largest oil supplier. In total, approximately 59% of India's crude oil was sourced from the Middle East, mostly, like I mentioned, Iraq, and the next biggest supplier would be Saudi. India increased its crude oil imports from Iran in 2016. That was when US and European sanctions had been lifted. However, again, India's import from Iran fell by 2019 after US again reimposed those sanctions on Iranian oil exports. Iran's share of India's oil import fell from 11% in 2018 to 2% in 2019. So this percentage was shared among other Middle Eastern countries, which replaced Iran's shipments. The next other significant sources of crude oil for India are the Americas and Africa, which mostly is Venezuela and Nigeria. So shares in both of these regions have fallen over the past few years as a result of a lot of economic disruptions over there, political disruptions in these areas, and their exports have been declined significantly over the last few years. Although small crude oil exports from the US to India has seen a growth. So from 2016 to 2019, the US export of crude oil to India has seen a 4% growth. So due to lack of adequate petroleum reserves, India has to depend mostly on crude oil imports also in the near future. According to one of BP's researchers, what they call Energy Outlook for 2050, India's imports are expected to double by 2050. So next we talk about LNG. During the past maybe 2 years, India has imported 25% more LNG due to the growing demand. Our most primary source of LNG is Qatar, with a 41% share, which has gone down from 83% in 2014. India has diversified its LNG sources over the past few years and increased its supply from several African nations, Australia, Oman, and also the United States. So in 2019, India was the fourth largest LNG importer, importing about 7% of the global total. Because India's natural gas demand has overrun its production capacity in the past several years, we are increasingly relying on imports for LNG. And also we are rapidly building the natural gas import infrastructure. India recently commissioned its 6th import LNG terminal, and also there are 4 more LNG import terminals which are currently being constructed, which is expected to come online by 2023. Currently, natural gas constitutes a relatively small share of India's total. Primarily, it's used for energy consumption. The government, although, has set a goal to increase the share of natural gas from 6% in 2018 to 15% in 2030 as a source for energy. So here we talk about the refineries and the production, petrochemical productions of India. Indian refinery industry has actually done really well in establishing itself as a major player globally. India, which is the second largest refiner, like I mentioned earlier, in the whole of Asia, is emerging as a refinery hub, which with a refining capacity which exceeds its actual demand. So as a result, India exports more petroleum products than it actually imports, like you can clearly see on the graph on the right. So the map also shows you how and where and all with the production capacity of the refineries throughout India. Like I mentioned earlier, you can see Gujarat has 3 major refineries. 2 of them belong to Reliance and 1 to Naira. So next, let's talk about the changes in the oil and gas regulations, which has happened in the recent past. Till the adoption of the liberalization policy in '91, petroleum exploration and production activities were carried out only by PSUs, which involved mostly ONGC and Oil India Limited. The new exploration licensing policy, or NELP for short, was formulated in 97, 98 by the government of India to provide for equal benefits for both the public as well as private sector companies in exploration for oil and gas. The activities in the E&P sector post this implementation of NELP saw a significant boost due to the policy, and it opened up the sector to a lot of private and foreign players, with like India allowing 100% FDI. So under NELP, which became effective in 1999, acreage were offered to participating companies through a process of open international competitive bidding, with where the government had given really attractive terms and conditions. The first round of offer of these blocks, the oil and gas blocks for exploration, was launched in 1999. However, the new exploration and licensing policy had also had a lot of issues. So for example, having separate policies and licenses for different hydrocarbons. For example, conventional oil and gas, coal bed methane, shale oil and gas. Everything had a different licensing policy. So unconventional hydrocarbons, mostly shale gas or shale oil, which were unknown during NELP, was a problem. Thus, this led to this inefficiencies in exploiting the natural gas. For example, when exploring for one kind of hydrocarbon, if a different kind of hydrocarbon was found, the oil and gas exploration companies had to go through a lot of licensing and a lot of bureaucracies to get new licenses, which added to the cost. So to tackle these issues, the government came up with the hydrocarbon exploration and licensing policy, which is called as HELP as well, which was formulated in 2016. I'll be speaking about that more, maybe the benefits about that in the next slide. Yeah. So here you can clearly see I'll talk about the major benefits over here. The first major benefit of HELP would be the revenue sharing model, where the government will receive a share of the gross revenue from the sale of oil, and oil and gas will not be sale of oil and gas, and the government will not be concerned with the cost incurred in actually exploring for the oil and gas. So the previous policy, NELP, was a profit sharing model, where profits were shared between the government and the contractor after recovery of the E&P cost, the exploration and the production cost. Once that was recovered, only then whatever profits were made by the company had to be shared with the government. Thus, it became necessary for the government to scrutinize these costs of the private oil and gas exploratory companies, and this led to many delays and disputes. So the new policy HELP is in tune with the government's effort to promote ease of doing business. The next advantage of the new policy would be the pricing. HELP has been marketed and with a pricing freedom per se. So before HELP, contracts were based on production sharing with a possibility of causing a loss to the government. There was a lot of manipulation which was carried out by the private players. So to reduce this complexity of handling the contracts, it was changed to revenue sharing. So under the new system, a graded system of royalty rates were introduced. Under the system, the royalty rates will decrease from shallow water to deep water to ultra deep water. In turn, it also encouraged players to explore for resources further deep into the sea. The next benefit is the open acreage licensing. Yeah. So under HELP, oil companies can select a block of their own choice. Previously, under NELP, exploration of hydrocarbons were limited only to the blocks which were being put on tender by the government. HELP marks the biggest transition from an era of government control to government support for the upstream E&P industry in India. The open acreage licensing policy removes restrictions on exploration by giving companies both the data and the freedom to explore area of their choice. So they were like hardly restricted from doing the exploratory work. The last major change is the uniform licensing. So HELP provides for a uniform licensing system that will cover all hydrocarbons such as oil, gas, coal bed methane, shale oil, ultra deep, deep. Everything is under one scanner. But under HELP, separate licenses had to be issued for exploring different types of hydrocarbons. Like I mentioned earlier, this led to additional cost as separate licenses is issued in different types of hydrocarbon while exploring for oil and gas. So next, I'll be talking about the future of oil and gas, which is an extremely important topic at this point of time. So because there's always a limit to the fossil fuel which is present in the earth that we are like increasingly consuming. We are ignorant of the fact that there will be a time, maybe within a few decades, when this fuel will run out because of global population rise. There's a growing demand for energy which is endangering our future maybe. So what will we do when fossil fuels run out? What energy sources can we rely on once this happens? So this graph here shows the future of energy reserves. So while we continuously use up fossil fuels without taking stock of what the future reserves look like, we should take note of the endpoints maybe shown in this in this graph, which are like dangerously close. Since our society is so dependent on fossil fuels, it becomes extremely important for us to know when these fuels will run out. So as per the research, out of many such research, as, what is shown in this graph, oil will end or maybe get over by 2052, which is like just 30 years from now. It says that gas might get over by 2060 and coal will last till 2090. Having said that, according to a recent study by BP, Earth has like 53 years of oil reserves. So it's very difficult to be certain about this, but we should mind the fact that it's getting over very quickly. So yeah, although in contrast to conventional gas reservoirs, natural gas can also be found. So here I'll be talking about maybe alternatives to all the normal kind of oil and gas, or the conventional oil and gas. So the conventional gas so natural gas can also be found in maybe more difficult to extract unconventional kind of a deposit, which includes coal beds, shales, or gas hydrates. So shale gas and coal seams are examples where the natural gas is still within the source rock. So this gas, which has not been migrated to porous or permeable reservoirs, since it's still in the source rock, it's more spread out and it's more difficult to recover these gases. So the next one I can talk about is tight gas, which occurs within extremely low permeable reservoir rocks, which are rocks with porosity of maybe less than 10% porosity and extremely low permeability. So the oil and gas is trapped and it can't move anywhere, and it can't get collected, which in a reservoir section which is easily exploitable. And next, I would talk about gas hydrates. So these are naturally occurring ice-like solids in which water molecules trap gas molecules. These are deep-seated sediments and usually occur in permafrost. So permafrost is a soil which is continuously frozen. This is usually found in the polar regions. So again, this is extremely difficult to explore, and as on today's technology, with today's price of oil and gas, this is not viable. So one more important aspect to highlight here is the technological advancements, like I mentioned, required to tap these new resources. Like I mentioned, it requires a lot of investment, and as on today, I don't think it's really feasible as of today's oil and gas rates, which which is not even $100 a barrel, it's not advisable or economical to extract these resources. So although there is a lot more to this industry, which if I start discussing it, will require a lot of time. That's all from my end today. Thank you all, and I hope you all are safe. And thanks again, Murtaza and ICAI for this wonderful opportunity. Thank you.
आनंद सर क्वेश्चन है दे दूं सर?
Yeah, I think Anuj will be taking over from here.
Yeah, if you can give me access to share my screen, please.
But before that, it was excellent presentation by Mr. Anand on an industry perspective, and though it looks very scary on the front that we will be outflow by 2080, all these fossil fuels resources, and looking India is far behind in terms of the oil productions and a lot of dependence on imports. It's an excellent presentation by Mr. Anand. We request him to just remain for few after this speaker, so for the question answer.
Sure. Thanks a lot.
Thank you.
Great, Anuj, over to you.
Yeah, Murtaza, if you can just let me know if my screen is up.
Yeah,
Yes,
it is there.
it is.
Yeah.
If you can just put on the presentation mode, yeah, yes.
Yeah, can you see the screen?
Yeah.
Perfect. Okay, I start now. And good evening, everyone. I hope you're well. These are difficult times. Please do take special care of yourself and your loved ones. Thanks, Murtaza, for the generous introduction you gave. And thanks, Anand, for setting the context so well. It makes my job easier. As you heard, Anand talked about the oil and gas sector, which has taken a beating because of the pandemic. And you would have seen oil prices tumbling down to negative for WTI price index due to the high refining, storage, and transportation costs. Since prices now they are now stabilizing between $35 to $45 per barrel. And we hope this brings in new investments into the sector, which has been really subdued since the start of this calendar. So in terms of the construct, maybe I can talk about some statistics about the sector, and largely these statistics are already covered by Anand, so I'll not duplicate my efforts and waste time. The idea of just putting up this slide is to make you understand some of the terms which I'm sure by now you will be acquainted with, the likes of HELP and likes of production sharing contract, revenue sharing contract. There are three segments in the sector which Anand talked about: upstream, midstream, and downstream. So I think this slide talks about the fact that India's consumption is say for as of March 2020 for that year was 233.2 million metric tons, and a significant part of that consumption was met by imports, and likewise for natural gas. Nearly 50% was met by imports. When I talk about crude oil, nearly 80% plus was met by imports. So I think the observation that emerges is India is importing heavily both crude oil and LNGs for meeting its domestic consumption requirements, and it is time that that relevant policies are put in place so that domestic production is incentivized and India is able to reduce some of its import bills. HELP is the new licensing policy which Anand talked about. Under this policy, you now have revenue sharing contracts which have replaced the production sharing contracts, which were based on profit sharing. Revenue sharing are now based on sharing of part of the revenues for licensing of hydrocarbon acreages. OALP is another part feature of HELP, where the explorers do not need to wait for the government to put blocks on tender. Instead, they can look into the tenders, look into the blocks using NDR, and then express interest for exploration of those blocks to the government on their own. Uniform licensing for various hydrocarbons Anand talked about. So this is really some of the sector statistics relevant to India and key developments that have happened since some of the historic ways of processing oil blocks. I move to the next slide. These are the three segments which again Anand talked about, three upstream, midstream and downstream. Upstream is about exploration, development and production. Midstream is about transportation. Downstream is about refining, retailing and marketing of petroleum products. Some of the sector constituents for upstream would be oil and gas exploration companies, likes of Reliance, ONGC, BP, Vedanta and Moshwaka. Reason I'm giving you names is that you get acquainted with these segments, and by associating those segments with companies and with the energy majors you know of. And another sector constituents for upstream could be oilfield service providers, which could be likes of Halliburton, Technip, Aker, and so on and so forth. Midstream would be largely involving pipeline constructions, terminal operations, and storage facilities. What we have GAIL do in India, IOCL. So they are all midstream players which are really engaged in transportation of LNG and oil. Downstream is about refining and retailing, which we have in India done largely by BPCLs and HPCLs and IOCLs. So that's the segment distribution of the oil and gas industry. We move to the next slide. Before I move to the next slide, one important point I would like to make here is there are special provisions in the income tax law relating to upstream companies because these companies are taxed in a very unique way. And while for midstream and downstream companies, there are no separate provisions as such, and they are governed by normal provisions of the income tax law. So we'll be spending more time on the upstream sector provisions, because these are provisions which are unique and they really need more attention than others. I move to the next slide. Yeah, I'm not. Yeah, is my screen visible still? Murtaza, if you can confirm.
It is, Anuj. It's visible.
Okay. Okay. So this is the typical contracting structure for upstream model. You have on the right hand side government owning oil blocks. In the middle you have various bidders, and generally because this sector involves huge investments, exploratory risks, and highly sophisticated technical expertise, you have a number of E&P players coming together in a consortium and bidding for these projects with the government. And these bidders could be residents, non-residents, or a combination of both. And then once these bids are accepted and a letter of award is issued, a production sharing contract or a revenue sharing contract, as the case may be, is signed with the government. And that production sharing contract gives license to the consortium to explore the oil blocks. Yeah, so that's the contracting model for upstream. There is a PSC signed by the consortium with the government, and then you have a consortium comprising of residents and non-resident players. So in next slides, we'll be talking about taxability of consortium, and taxability which consortium can include residents and non-residents, and also some of the non-resident service providers. So these consortiums may require reaching out to various oil field service providers for various specific technical expertise, like for drilling, for seismic surveys, for seismic data interpretation. So for all those requirements, the consortium may reach out to various oil field service providers to provide those specific services. So first, we start with taxation of contractors, which is really the consortium, which in turn engage or sign the production sharing contract or the revenue sharing contract with the government. Yeah. So, under the tax law, Section 42 governs taxation of upstream companies which are engaged in prospecting, production, and exploration of mineral oils, and under a PSC or RSC signed with the Government of India, and which contract has been laid before the Parliament and approved by both houses. And so the construct or the permissibility of some of the allowances are covered in section 42, and those allowances are supposed to be read with a contract signed with the government. It is very important and critical that that some of the allowances which can be claimed as deduction against the taxable income are specifically expressed in the contract with the government, because if some of those expenses are not mentioned in the contract and also not getting covered in section 42(1), then those expenses may be permanently not allowable, and it could be a sunk cost for those operators. So I start now with and before I move forward, you saw on the last slide that there is a consortium which has certain resident and non-resident players. And whenever we talk about consortium, the concept of AOP comes into the forefront. And here I just want to clarify that the government has clarified and issued a circular that when certain members come together, form a consortium, and sign up a production sharing or a revenue sharing contract with the government, then they will not be taxed as an AOP or a BOI, but they will be taxed, members will be taxed for their respective share as per provisions of section 42(1). So here there is a specific dispensation from AOP risk clarified by the government. So for various consortium members, so if there are 3 members holding 40% participating interest in the oil block, then each such member will be taxed for their respective share as per the provisions of section 42(1). Now we go to section 42(1), and there are a list of allowances, deductions which can be claimed under section 42(1). And then we'll go to what is covered as allowance under Article 16 of revenue sharing contract and Article 17 of production sharing contract. The reason I'm wanting to read these allowances with what is covered in RSC and PSC is because they need to be read together. If there is a conflict between the two, Income Tax Act will be overridden by the production sharing contract, and therefore it is important that there is seamless mention of some of the deductions in the contract signed with the government. So I'll be using here 3 terms: exploration and drilling, production, and development. And these terms are all defined in the production sharing contract. Let me just briefly explain what is exploration operations. So these really are operations which are done in the contract area for searching petroleum, and includes geological, topographical, and seismic surveys, including drilling of exploration wells. Exploration operations is this. Now we move to development operations. Development operations include purchase, shipment, and storage of equipment. It includes testing of development wells, installation of platforms, laying of pipelines, and delivery of crude oil, gas, etc. Production is the third part, production operations, which includes operations for producing petroleum from the development area after commencement of production. So these 3 expenses are separately dealt with in section 42 and the contracts with the government. Now, having understood these 3 terms separately, we look at first what is sought to be allowed by section 42(1). The first expense is infructuous or abortive exploration expense in respect of any area which is surrendered before the beginning of commercial production. So if there are certain expenses incurred by the oil and gas players, explorers, in respect of a contract area where there could not be a commercial delivery, or there could not be success in exploration, then that area is supposed to be surrendered to the government. And in the year of surrender of area to the government, all the expenses which are infructuous or abortive are supposed to be accumulated and allowed as deduction in that year in which the well is surrendered. That's one. Number 2 is expenses relating to drilling or exploration activities. Those expenses are also allowed as deduction, which is mentioned in section 42(1). The third category of expense covered in 42 is depletion of mineral oils after the beginning of commercial production. So these 3 expenses find feature in section 42(1), which can be claimed as a deduction while computing the taxable income for a contractor or an operator. Now, just opposing this to first production sharing contract, and when you look at the model production sharing contract, you go to Article 17 that deals with taxes. That's what is covered in the table on the right hand side. There are four types of expenses which are covered and which are allowed as deduction under the production sharing contract. One is exploration and drilling. Both capital and revenue expenses are supposed to be accumulated and then deductible from the year of commercial production. Now, for this exploration and drilling expense, the taxpayer has an option either to claim those expense in full in the year of commercial production, or to amortize this expense over next 10 years from the year of commercial production. That's an option given to the taxpayer with regard to the manner of claiming deduction under the production sharing contract. Category 2 of expense is production and development, which is allowable as per provisions of the Income Tax Act mentioned in Article 17 of the Model PSC. A third is unsuccessful exploration cost in a particular oil block. So this last two rows talk about a situation where, say, a particular explorer has two blocks which are being explored. One is successful, other is not. So the block which is not successful and certain expenses have been incurred in that block, those expenses are supposed to be accumulated and then claimed as deduction against income from the other successful block which has started to commercially produce oil or natural gas. The last row is where there is an unsuccessful block and the successful block, and successful block has already begun commercial production. Then any expenses incurred for the unsuccessful block are allowed to be offset against revenues from the successful block. So this is the fungibility in terms of deductions allowed or permitted by the production sharing contract for a taxpayer which has more than one blocks for exploration. Now, when I go to revenue sharing contract, Article 16 there deals with taxes, and it is very cryptic as compared to a production sharing contract. The revenue sharing contract simply says that all expenses in relation to exploration, development, and production shall be allowable as deduction under Section 42 of the Income Tax Act. So there are these three different schemes of law, Section 42(1), PSC, and RSC. Now, say if there is an explorer today signing up a RSC with the government and then calculating its taxable income, the explorer will need to look into Model RSC Article 16 and Section 42(1) and will marry the two when it will calculate its taxable income. Now, there's some issues which pop up when these two things are read together. So you will note that production sharing contract, or rather you will note that there is a deduction of development and production expenses mentioned in the RSC, but that specific reference to development and production cost is not featuring in 42(1). So what happens when those references are not covered in 42(1)? Will those expenses be allowed ever, or it'll be a sunk cost where the taxpayer will not get benefit of those expenses? Another point is those unsuccessful and abortive expenses that fines feature in 42 section, but not in the RSC. So then there's again a disconnect between the two, and which will really question the liability of those expenses. So this has been the long-standing ask from us, and we've made recommendations to the government that there should be a better alignment between Section 42(1) and the revenue sharing contract, so that taxpayers and those avoidable issues of claiming deduction are avoided, and there is and litigation on these issues can be curtailed. So these were the aspects on Section 42(1), which really deals with the calculation of taxable income for the oil explorers. Now I move to Section 42(2), which is really a very interesting section. So you would have certain explorers entering into these revenue sharing contracts with the government in the natural progression. You can also have situations where where some of the existing players who sign up contracts with the government would want to exit while those expenses are being incurred and the well has not begun commercial production. So for those processes and for those situations when there is an existing player holding a participating interest in the oil block wants to transfer to a new strategic investor, and that new investor comes in and joins the existing players for exploration, that situation is called farm in, where a new strategic investor comes in the oil farm and begins exploration activities. That's farm in. And there's a corresponding provision called farm out, and farm out is referred to, and farm out is really referred to the transferor which exits the contract with the government and hands over the participating interest to the new investor. Now, when I go to section 42(2), it deals with tax implications for the transferor, which is the investor which is exiting the contract with the government. There are no specific provisions dealing with tax implications for the new strategic investor that joins the existing players. Then, because typically in a situation like this, there'll be some money that will be paid by the new investor to the existing investor who is exiting to gain access to the participating interest in the oil block. So what happens to that expense or amount or proceeds paid by the new investor to the transferor? Will that expense be capitalized for the investor and then it'll be allowed as depreciation, or will that expense be treated like like it would have been treated for the existing explorer? It could be allowed, not allowed, subject to section 42(1). So because there were no specific provisions in the law, the CBDT clarified this aspect specifically and issued a circular stating that whatever amount that the new investor brings in and gives to the transferor, that will be treated as a capital asset. It will be similar to an intangible asset like any other business or commercial license, and it will be eligible for tax depreciation at 25% rate. So this has been specifically clarified by the government. Now, on this aspect, when there is a transferor involved, and that transferor could be resident or non-resident, will there be a requirement on the new investor to undertake tax withholding when it makes payments to the transferor? Now, to examine any withholding requirements, one needs to look into the taxability of proceeds in the hands of the transferor. Now, here, if you're talking about a non-resident transferor exiting from the oil block, one needs to go into section 195 and see if that sale proceeds are taxable in the hands of the transferor. So to examine taxability for the transferor, there is section 42(2), which is what we earlier discussed, called farm out. Now, farm out deals with the implications for the transferor, one who is exiting from the oil block and hands over his share of participating interest to the new strategic investor. Now, there are two buckets here, the two baskets. One is whatever the transferor gets, that is called as capital proceeds. That capital proceeds, okay, so maybe there are some terms here used. Maybe I can just give examples and then we can understand these terms better. Suppose today a contract is signed, say a revenue sharing contract with the government. Say 100 is expense already incurred by the explorers in exploring oil wells. Now, say within 2-3 years down the line, one of the members wants to exit, and say for instance that member has incurred only 100 worth of expense, and he wants to exit. And what he's getting in return from the new investor, it could be more than 100, less than 100. There could be different situations. So here it is talking about situation where capital proceeds exceeds expense remaining to be allowed, or situation where capital proceeds do not exceed expense remaining to be allowed. The reason I'm here saying not expense incurred but expense remaining to be allowed is because as and when those expenses are incurred by the oil explorers, not all expenses are allowed as they're incurred, but they're allowed subject to 42(1), which we read is a very complex provision, and then it links back to the contract for allowability of various expenses. Now, if capital proceeds are less than expenditure remaining to be allowed, then the difference is treated as a business loss, which is deductible in the year of transfer. Second situation is where capital proceeds are greater than expenditure remaining to be allowed, then and if those capital proceeds exceed the total expense, then the differential is capital gains. And maybe we can just look into the illustration on the next slide. Yeah. So situation one is where expenditure incurred in total is 10,000, expenditure remaining to be allowed is 6,000, and proceeds are 5,000. So 5,000 is what the transferor has received on transfer of participating interest, and expenditure remaining to be allowed was 6,000. 4,000 was claimed as deduction as and when those expenses were incurred as per 42.1. Now in situation one, 1,000 will be claimed as a business loss, and there'll be no capital gains, no surplus, because what you have received is less than what you have incurred in total and what you have claimed deduction of in total. Situation two is where what you have received is 7,000, which is in excess of expenditure remaining to be allowed. So out of 10,000, 4,000 you've already taken benefit of by way of deduction. 6,000 is remaining to be allowed. You receive more than 6,000. You receive 7,000. Here 1,000 will be your business income. It'll be taxed in the year of transfer. Now, if you go to situation three, where the transferor receives 15,000 on transfer of participating interest from the new investor, then 15,000 is even higher than the original expenditure incurred, which was 10,000. Now 5,000 may be taxed as capital gains, and I'll come to this capital gains taxation, the reason why I'm saying it may be taxed. Now expenditure already claimed deduction of is 4,000, remaining to be allowed is 6,000. You have received 15,000. Now 4,000 will be taxed as business income. It is similar to situation two. Now 5,000, when you read section 42.2, it is unclear if that surplus over and above the expenditure in total incurred, which is 10,000, how will that be taxed, is not defined in section 42.2. But we have jurisprudence which says that this surplus will be taxed as capital gains, and this is the Chennai Tribunal ruling in the case of Moshbacker, which goes on to explain that this excess is nothing but because this participating interest were to be seen as an intangible asset, any surplus you receive over amount already expensed is to be treated as consideration for transfer of the capital asset, and more specifically taxed as cap gains. So it has now been clarified, at least judicially, that this surplus will be taxed as capital gains. I go back and I go to the next provision, which is taxation of service providers. And I'm conscious of time, so I have a hard stop at 6:40. I'll take 10 more minutes. So this is about taxation of oil field service providers, which is what we understood in the diagram, that there's a consortium which signs up a contract with the government, and this consortium, while it is taking up the investment, exploration, and technical risks, it may also on need basis reach out to various oil field service providers to draw on necessary support for exploration purposes, and that support could be for various seismic surveys, drillings, for supply of pipelines, umbilicals, and so on and so forth. Now, there is a specific provision in the tax law, section 44BB, which deals with taxability of those non-resident oil field service providers. And this section is applicable where those service providers provide services in connection with, or they provide plant and machinery, which is used in prospecting, extraction, or production of mineral oils. So when those non-resident service providers come into the picture and they provide services to the contractors in assisting them explore oil, then this section triggers. And under this section, which is really a presumptive section, it presumes that out of the gross receipts, 10% will be the deemed income. So there is a dispensation from requirement of maintaining books of accounts. There is a presumption that 90% is deemed expense, 10% will be the deemed income for those non-resident service providers. And the effective tax rate for non-residents is 40% plus surcharge cess, makes it 43.68. So 43.68 applied on deemed 10% profit comes to the effective rate of 4.368% on the gross receipts. So no requirement to maintain books of accounts. Simply pay tax on at 4.368% of what you receive in gross from the contractors. Under this section, there is also an enabler wherein those service providers have an option to prepare books of accounts, get them audited and produced before the government if required. In case they were to believe that their taxability is lower than deemed taxability rate of 10%. So in those situations, they can prepare books of accounts, show that they're earning less than 10%, get their books of accounts audited, and explain to the authorities if they're audited that this is the real profitability margin, and then this is the rate they pay tax on. Section 44BB also has a provision which says that this section will apply where there are services incurred in exploration activities, but those services are not fee for technical services as defined in the tax law. And that has been the debate for a lot of years, and there have been conflicting rulings as to what takes precedence. Because when we talk about these services, seismic service, data interpretation, drawing of umbilicals, there are engineers involved here, and there is a lot of technical inputs and various technical services put to ploy here for doing these services, and more often than not they will be technical services. So the Supreme Court in the case of ONGC has put this controversy to rest to say that section 44BB is a specific provision, and even if there are technical services, but those technical services relate to oil exploration, then they'll be governed by section 44BB, notwithstanding the fact that they are technical services. They in a way have ruled that those services will not be technical services, and they'll be more specifically covered in section 44BB. Another concession given to these oilfield service providers is there'll be no liability under minimum alternate tax in case they are not maintaining books of accounts paying tax at 4.368% on gross receipts. The only rider here is those service providers need to earn income only from these projects, and they cannot be earning any other income, because the section says the income should comprise solely from profits and gains in relation to which are covered in 44BB. So some of the issues relating to this provision are 44BB versus technical services, what has been put to rest by the Supreme Court decision in ONGC. And reimbursements. So reimbursements are covered under section 44BB, other than those reimbursements which are in the nature of taxes like customs and GSTs, because these really. So I think the controversy here is what will gross receipts cover? Will those gross receipts cover reimbursements on account of taxes? Answer is no, because gross receipts need to be receipts in connection with provision of oilfield services. Any other reimbursements, will those reimbursements be covered? Answer is yes, because the section is wide enough to cover reimbursements in connection with the provision of services. MOB, demob is really about mobilization, demobilization of transport equipment to the oil offshore platforms to provide the service. Any consideration received for this transportation service is also covered and taxed under 44BB. That's all we had on the upstream companies. Now I'll move quickly to the midstream and then to the downstream. As I said earlier, so midstream is there are no specific provisions for taxation of midstream companies, in which case the normal provisions apply. The special benefit, one special benefit under the tax law for midstream companies is featuring in section 35 AD of the Income Tax Act, where any capital expenditure incurred in laying down of cross-country petroleum or pipelines for transportation of gas or storage, then they will be covered. They'll be allowed deduction, which are linked to investment and not really profit linked. So this is a deviation. This is the shift that the government has made from tax holiday, which were contained in 80IB. So they have disallowed tax holiday which are profit linked deductions from 80IB to now investment linked deductions under 35AD. So whatever you expense, it could be capital or revenue, will be allowed as deduction if those expenses relate to laying of pipelines, including storage facilities. In fact, likes of GAIL and IOCL have been taking benefit of this section when they've laid out various gas pipelines, and these provisions have been allowed, generally speaking. We also talked about those players because midstream deals with transportation. Transportation generally for these, and we earlier read that a lot of domestic gas requirements are met by way of imports, and these imports are generally done by various foreign LNG supplying companies. So Indian companies likes of GAIL say enter into contracts for purchase of LNGs, and that LNG is also transported by various tankers, LNG carriers, and FPSOs to the port terminals in India. Now there are again various issues involved here, which could be ranging from taxation of those vessel owners, vessel charterers. So very briefly putting up, the income tax law says that if there is a non-resident vessel owner or a vessel owner which uses the vessel to help in transportation business, then that vessel owner, if vessel owner comes from a treaty jurisdiction, can take benefit of no taxation, because this will be covered in Article 8, which exempts profits from operation of ships in international traffic, and only the resident state has the right to tax this income, which is really the home state of the ship owner and not the source state, which is India. So there are some tax nuances at play here as to if the payment is for hire of ship, or is it a payment for carriage of goods. So I think if the payment is for carriage of goods, then section 172 or 44B could apply. And if it is a payment for hire of ship, then I think tax treaty provisions could also come in handy, and this payment could also be taxed as royalty, depending upon the contracting arrangements, which could be a bareboat charter or a time charter party, and so on and so forth. The last slide is taxation for downstream sector, which is the sector for retailing and marketing of petroleum products. Again, no specific provisions. The normal provisions apply. No tax holiday sunset was sunset. There's a sunset date for refining, and therefore tax holiday under 80 IB is not now possible. The only last point, which is really an important point here, is the government last year introduced concessional corporate tax rates, which is 15% for new manufacturing companies and 22% for existing companies, provided these companies do not avail tax incentives. Now, the question really here is whether refining will qualify as manufacturing, and if it does, then there could be a lower tax rate of 15% applicable to those refineries. And really, when you look at the definition of manufacturing in the tax law, it refers to change in the chemical composition or molecular formula, and then something which comes up has a different character and a different use, something which is marketable. So when you attribute these facts to say various to any particular example, so you could take an example of say conversion of LNG into maybe a propylene or a propylene or a polypropylene products, which has a different molecular structure and a different marketability and a different use altogether. Then one can argue that this conversion from LNG to these hydrocarbon elements results in a new chemical composition, and they should qualify as manufacturing for the purpose of tax law, in which case the lower tax rate can be explored. Yeah, so I think this is all from my side on taxation for these three segments in the oil and gas industry. If there are any questions, I'm happy to take. Over to you, Murtaza.
We definitely have questions, and mainly most of them are tax related. Mishra ji, एक बार questions put up करिए. Rajesh bhai, if you can read out the questions, or Anuj can directly also read out once on the screen. Okay?
Yeah, Anuj can be able to do it more better.
So Anuj, my request will be if we can finish in the 5 to 10 minutes, maybe 2-3 questions. Huh?
Maybe I think Anand, maybe it may relate to you also, so you can also see if it is related to you. Then
yes, I'm
Anuj,
just
you want us to read?
No, I can read myself. So the first question really is, if an SSC exercises concessional tax regime for 115BAA, which is 22%, then the SSC cannot claim deduction under 33ABA of the Act. In terms of 33ABA6, amount withdrawn from site restoration utilized for the purpose of incurring expenditure in connection with business of extraction and production shall not be allowed as deduction. Also, in terms of 33 ABA5, amount withdrawn and closure shall be taxable under PGBP. It may be noted that the deposit in site restoration is compulsorily under PSEs. In light of above, whether the taxpayer can claim deduction under 37 in the year in which the provision towards is made on scientific basis as revenue expense after opting for 115B AA. I think 2 points that I'll make here is if an election is made into section 115B AA, that election is permanent. It cannot be subsequently revoked. So the section very clearly says that tomorrow it cannot be reversed and you can go back to the normal provisions. So if it is elected, then it exists forever. So if an election is made, then clearly 35 ABA 6 will not be available. You cannot take deduction of expense under that section once you have elected. And really the question is, if you have not elected and if you have contributed to site restoration fund, then expense will be allowable as per 33 ABA. I go down. I think this is relating to the first part. I think alternatively, where the provision for site restoration capitalized in books of accounts can be claimed as deduction under 32 as depreciation. Any case laws to support the claim for said deduction. I think it is a special code in the sense section 32 and really section 33 ABA, which is contributions to site restoration fund, in which expenses are claimed as a revenue expense. I'll say that it will be difficult to capitalize those expenses and take tax depreciation, because the construct of the law is that those expenses will be taken as a allowance or revenue expense as and when they're contributed to the fund. Maybe question 5 is for Anand. Maybe you can take up question 5 as
5 and 6 is 5 and 6 is for Anand.
Yeah.
Anand.
Yeah. So the first question talks about what is the average cost of production of oil and gas, shale and others. So you can't actually get an average cost because it depends on the type of production. If it's offshore, if it's deep water, it's shallow water, if it's land, every aspect changes the cost of actually producing the oil and gas. The shallow gas is, for example, extremely cheap to produce compared to like what for example Reliance is doing in India. So to answer your question, you can't really put a price, an average price like that. The second question is, will Petronet get classified into midstream? Is the only midstream company to help LNG import? So Petronet can be classified into midstream as well as downstream, because they also have regasification plants, and they also supply gas. So yeah, to answer your question, it is both midstream as well as downstream.
I think Anuj, you can answer the question number 3rd.
Yeah, question 3rd is what I answered. Maybe I can pick up 4. 3rd I answered.
4, yeah, I think you have answered it. 4th.
Yeah, so 4th is about where there is an existing tax holiday under 80IB 9 claimed by a refiner, not by, or by the explorers. And if there is a transfer of division under a BTA to a new purchaser, whether the purchaser will be eligible for deduction. I think answer is difficult, because you have a specific provision under 80IA, which says that if in case of amalgamations or mergers, the investor or the new purchaser will not be entitled to carry forward the tax holiday provisions. And there is a provision in 80IB also which says that some of the provisions of 80IA will be read in 80IB as well. So if I keep those provisions in mind as those provisions read in 80IAB, then I think the purchaser should not be entitled to tax holiday under 80IB when in respect of units purchased under a BTA.
I think.
So have we covered all the questions?
Yeah, if there are any other questions other than these 6, I think 6 largely we've covered. If there are other questions, we can maybe we can read on the screen.
So Anuj, what we can do is, if there are any further questions, we can even mail it to you and Anand, and we can seek your answers, and then we can send it back to the participants.
Sure, sounds well to me.
Yeah, I think that is better.
Sure. So,
Sorry, guys, did
Rajesh,
I miss anything? Sorry, Maqbool here. Did I join you late?
no, we are just about starting the panel. We just completed 2 sessions, Mr. Maqbool. We are starting the panel in a minute. So before we move to the panel, Rajesh bhai, may I request to carry out a vote of thanks for both the speakers, please.
Yeah, it was a wonderful session, both industry and tax wide, and Anand and Anuj both has covered very vastly and very good presentation. So, on behalf of WRC, a hearty vote of thanks to both of you, and you can still stay on with the panel discussion. Thank you very much.
Thanks a lot. Yeah, it was a
Thank you.
wonderful experience.
So, great, Anand and Anuj, thank you very much. And with that, let us move to the panel straight away. And we have all the experts, and let me thank each one of them. So, first, Mr. Maqbool is joining us from Oman, and he's an oil and gas expert all throughout. And I'm sure Sujaya will talk us about his background as well. Ashish Jain from Naira Energy. Ashish, welcome. Then Raj Mullick from Reliance Industries. Raj, welcome. And Vineet Kishor from Shell. Vineet, welcome to you as well. So with that, immediately what I'll do is I will do a brief introduction of Sujaya. She is going to be moderating the panel and then hand over to her, and she will introduce all the panelists and she'll take it further. So over to, it is really a pleasure to introduce Sujaya. Sujaya is a postgraduate diploma in business management from NMIMS and has done her bachelor's in mechanical engineering. She comes with close to 11 years of experience in oil and gas industry. Sujaya is a senior manager with Protivity and is responsible for the delivery of consulting services to clients in energy and utility sector, both in India and Middle East. Before joining Protivity, she worked with Accenture for his upstream client in Australia. Sujaya has worked in major oil and gas companies like Reliance Industries in his flagship Jamnagar refinery and petrochemical complex, and has commissioning experience in IOCL's Paradip refinery prior to her consulting stint. So with that, Sujaya, welcome. And I hand over to you, Sujaya, and you can take it forward from here. You're on mute, Sujaya. You're on mute.
Thank you so much, Murtuza sir, for the introduction. I would like to take this opportunity to thank WIRC of ICAI for giving us this platform, and in particular Murtuza sir for taking this initiative. I would like to welcome all the participants and panelists again to the panel discussion on oil and gas industry. So as Murtuza sir has already mentioned, we have in the panel today CA Ashish Jain. I'll give a brief introduction. Mr. Ashish Jain is a chartered accountant and a postgraduate diploma in business management, specializing in finance. He's also an alumni of Narsi Monjee College of Commerce and Economics, Mumbai. His professional experience spans over 20 years with large organizations in India, leading audit, risk management, compliance, and governance functions across multiple geographies. Currently, Mr. Jain is the Chief Internal Audit Officer of Naira Energy, owned by Rosneft-led consortium. Naira Energy operates India's second largest single-site, fully integrated refinery at Vadina, Gujarat, which includes captive power plant, oil terminal jetty, and largest private retail network, which comprises of 5,800 outlets across India. He heads the internal audit function and reports to the Director's Office and Audit Committee. Prior to Naira Energy, Mr. Jain has worked in Royal Dutch Shell for close to 10 years in its upstream sector in India as a principal auditor, heading the audit and governance function of India. He was responsible to develop, review, and deliver an independent risk-based audit program, establish audit methodologies in alignment with group audit, influence and support first line of defense stakeholders to strengthen control design through delivery of focused audit opinions, proposals. He managed SOX compliance, becoming audit performed by Comptroller and Auditor General of India for the upstream operations. Mr. Jain also headed internal audit and risk management function for Total Petroleum India Private Limited. Total's business portfolio in India included LPG terminal and distribution network, lubricants, and industrial specialty chemicals. We welcome you again, Mr. Ashish Jain, sir. Now I would move on to introduce Mr. Raj Mullick. Mr. Raj Mullick is a chartered accountant, cost and management accountant, and an alumni of Stanford University. His professional experience spans over 22 years in areas of strategic, financial planning, IGAP and Ind AS, mergers and acquisitions, tax planning in different industry verticals in multicultural and multinational environment. He has managed 500 plus entities, including the flagship Reliance Industries Limited. He has driven several business transformation initiatives and specializes in SAP implementation, cost planning and control, financial risk management, and performance analysis. Currently, Mr. Mullick is a Senior Executive Vice President and Chief Accounts Officer in Reliance Industries Limited. Mr. Mullick is a nominated member of Accounts, Audit and Tax Committees of Bombay Chamber of Commerce. He is also a member of Accounts and Audit Committee of Bombay Chartered Accountant Society. He was an ex-member of Ind AS Committee of ICAI, which is the epic body for accounting regulation in India, for several years. Mr. Mullick was conferred with the prestigious Professional Achiever Award by the Institute of Chartered Accountants of India. He has been a speaker in several professional forums, including ICAI, Bombay Chartered Accountants Society, and IMA, which is the Institute of Management Accountants. He has actively contributed in the field of professional development and academics. Mr. Mullick is an avid runner and has run numerous half marathons in past few years. We welcome you, sir.
Thank you.
Now I move on to introduce Mr. Vineet. Mr. Vineet Kishor is a chartered accountant with 20 years of experience. He has experience in a variety of industries, including manufacturing. He has worked in the Big Four for 5 years before moving to the industry. Mr. Kishor is currently heading the retail finance team for Royal Dutch Shell in India. Prior to Shell, he has worked with large MNCs, including GE and ArcelorMittal. We welcome you, sir.
Thank you.
Now I move on to introduce Mr. Maqbool. Mr. Maqbool Al-Lawati is a citizen of the Sultanate of Oman, and he is a fellow member of the Chartered Association of Certified Accountants, UK, and alumni of International Institute of Management Development, IMD, Lausanne, Switzerland, and graduate of Southeastern Oklahoma State University, USA. He has been associated with oil and gas industry in Oman and Brunei, Darussalam since 1979, and has held various senior positions in Petroleum Development Oman LLC, Brunei Shell Petroleum, and Oman Liquefied Natural Gas companies. Mr. Al-Lawati is a proprietor of MHMY Auditors, a member firm of IAPA, established since 1990 in Muscat, Sultanate of Oman, serving over 250 clients in the fields of stat and internal audits, tax advisory, outsourcing, feasibility studies, and related activities. Mr. Al-Lawati is also partner chairman of Stellar Consulting LLC and Lighthouse LLC, both consulting firms engaged in strategic management consulting and several other consulting services. Mr. Al-Lawati serves on the board of Musandan Par Company and SQOG Company as board member and chairman of audit committee. Earlier, he served on the board of Al Hassan Engineering Company, SAOG, as chairman of the board, chairman of the executive committee, as well as a member of Audit and Remunerations and Nominations Committee. Until March 2013, Mr. Allavati was Chief Financial Officer at Oman LNG, responsible for company's financial activities as well as supply chain management. He was also chairman of the ERP committee and deputy chairman of Oman's LNG tender board. Earlier at PDO, he participated in all aspects of finance, including PDO pension investment portfolios and many other high-level portfolios. Mr. Al-Nawati was actively engaged in the local business development within Oman, where PDO had the privilege being the key provider of private business activity within Oman, second only to government of Sultanate of Oman. Mr. Al-Nawati has also been engaged with the numerous charitable social activities. He served as the chairman of the member advisory committee of the ACCA, that is the Association of Chartered Certificate Accountants, Oman chapter, since it was established in 2014 until 2019, and continues to serve as its advisory member. He is an ardent cricket enthusiast and has been active member of Oman Cricket Academy since the 1980s. We welcome you, sir. So, moving on
Thank you.
to the broad agenda.
Sujaya, just before
Yes.
you get started, I would request the panelists, if it is possible, although we are 5-7 minutes late, maybe if we can extend to 10 more minutes and take the participants' questions also towards the end. So that is only the request. Yeah.
Yeah, we are fine.
Over to you. Yeah, over to you, Sujaya.
Sure.
Thank you. Thank you.
Thank you.
So today's broad agenda for the discussion would be around the structure and value chain of oil and gas sector in brief, strategies to mitigate the COVID-19 challenge, the future post-COVID-19, impact of plunge in crude prices on upstream sector, major sectoral reforms, considerations for setting up retail outlets, what are the significant risks in the industry, and there would be some ideas or some light rather thrown on the investment process, then the effect of digitization on the retail sector, impact of reduction in carbon footprint, and COVID's impact on decarbonization. And also there would be towards the end insights from all our panelists on the role of financial professionals in this particular sector. So I would like to start the panel discussion by requesting all our panelists to give opening remarks. I would like to start with Ashish Jain, sir. Sir, please, if you can start with the opening remarks.
Sure. So thank you, Sujaya, and thank you, Mr. Murtuza and WIRC for having me here. I would like to build a context, for the oil and gas sector, and then a bit on the projection before I go into the specific element of what oil and gas sector is all about. Given that most of the participants here today come from accounting and finance background, I think it's very important to understand oil and gas from two important lenses. The first lens is that oil and gas is one of the most capital intensive sector that one can have. The second most important lens is that most of this capital is a highly risk intensive capital. So once you understand these two aspects, your ability to look through oil and gas really changes. So with that perspective, I would just like to touch a bit on the projection of oil and gas before I go into the sector piece. Media traditionally has projected, for right or wrong reasons, oil and gas as a protectionist, monopolistic, profiteering sector. Now, having spent 12 out of my 20 years career, it's highly unfair and nothing can be further from truth. So I'm really happy that sessions like these help us to reach out to various sections and help understand what oil and gas comprises of and what are the challenges and achievements of oil and gas for the society as a whole. Yeah. So coming specifically, to understand what oil and gas is. So traditionally, it is,
So we'll take it in.
comprised.
Yes, Ashish, we'll just come to that in details. So we'll just start off with opening remarks for 1 minute from everyone.
Please go ahead, please.
Thank you, Ashish. So Raj, sir, if you can please provide your opening remarks.
Yeah, good evening, ladies and gentlemen, and good evening, Sujaya. Thanks to WRC for inviting me to share my thoughts. It's been an absolute honor. Friends, clearly this is unprecedented times. One of the key outcomes of COVID-19 has been significant demand destruction of traveling. The jets flights are traveling less than 50% of the capacity. With working from home, annual oil demand fell by 20%. Even after recovery of China, it is 13%. So this is the situation. Oil price in the around April 18th, it was hovering around $14 a barrel. Now maybe on 36, 38. Cracks, jet cracks, which was 20 a year back, it is now around 0. Gas well cracks around 20 in April, now around 0. Singapore, the benchmark GRM, was negative significant part of September. Now maybe it is around $1 or $1 or $2. Shale gas, as we know that, in 30 or 40% of shale gas operations will not technically viable less than $35 a barrel. And most of the period oil was below $35 a barrel. So you can see the situation. So industry has responded. Industry has responded by completely capex cut and production cut. Saudi Aramco has announced around 50% capex cut in August. Rigs which are used in exploration is around 30% or 40% lower than what it used to be a year back. So GDP has contracted 24% in Q1. Q2, the expected number is around 10%. And there's one thing I need to say, a ray of light. Petrochemicals industry will be a new savior. It is almost, I think, back to pre-COVID time, or 80%, 90% of pre-COVID time. We see a lot of traction there. In fact, the polyester, which is labor intensive, that is also doing well. So this is unprecedented time, and this is the backdrop which I've set. And hopefully, all of us will speak more on this in the due course of this. Thank you.
Thank you so much. Thank you, sir. Sir Vineet, sir, I would like you to provide your opening remarks, please.
Sure. I think thanks, Sujaya. So I'll be touching on the fuel retailing part. I think we have really seen today that downstream includes refining, processing, and marketing. So just to set the context, marketing is the is that part of the industry which directly comes in contact with the consumer to sell. India has the third largest consumer in terms of oil. Where is this consumption going? Transport sector, which is both B2B and B2C, is one of the biggest area for fuel consumption. Energy demand India is still growing, and it is anticipated that it will still continue to grow. It is expected that it will become double by 2035. In terms of the players and in terms of the number of fuel pumps, so today we have got about approximately 73,000 sites. It was about 60,000 sites maybe about 3 years back, and it is just multiplying at a good rate. Private players like Shell, Reliance, Naira would account for about 12 to 15% now in terms of the fuel pumps. There will be new players coming up in terms of Total, in terms of partnership between Adani and Total, Reliance and BP. With the growth and with the clear information that investments are still going to come into this sector, the sector is still growing, this remains a very interesting time.
Agreed, sir. Can't agree more. So thanks a lot for that. Maqbool, sir, please, your opening remarks.
Well, yeah, thank you. It's my pleasure to join, and I really appreciate the invite to join the panelists. Although I have been outside the oil and gas business for now almost 7-8 years since I retired in 2013, I do have some sort of a link with it. I think, again, unlike the rest of the panelists coming from an overseas, not from India, as well as from a country which is an oil-producing country, I think probably I'll be able to sort of give a little different perspective from the more global point of view. Oil industry for Oman and for the Middle East and the Gulf, in fact, for the whole world, has gone through quite a significant changes. It has brought in a lot of sort of opportunities for the region. Not only within the Gulf states, which really until our last 40 years were sort of struggling in terms of generating revenues. The kind of nature we have. Oil industry, oil and gas has given a lot of opportunities. In Oman, I think we've been very lucky that the government has used most of those revenues to develop the country. Pre-70, we had very little infrastructure, and in the last 40 years, our Sultan has put in a lot of money in developing not only the infrastructure in the country, but as well sending out most of the Omanis overseas. I think I was probably one of the earliest one in the early 70s where I got a scholarship from the government to go to USA and study. Since then, I think every year some of the funds have been going into developing almost 400-500 Omanis. Currently, we also have a lot of universities in Oman, so it's helping put the focus on the education. When the Sultan came in, Sultan Qaboos, may God bless his soul, I think he passed away early this year. His three aims were for the people to get education, health, and I think also infrastructure, water, electricity, sort of things, which I think right now we can proudly say that we are very well placed around the world in all those aspects. So oil and gas industry has been quite a blessing for us. Although over the last 8-10 years, there have been challenging. Maybe one of the now challenges is for us to see how we can contain our expenditure to align ourselves with the low oil prices and the revenues. The country is growing, the expenditure is growing, all the infrastructure now needs a lot of maintenance. So I think quite a challenging time for us, and which is really around the world a little more of an opportunity. So those are my sort of prospects from this industry. Yeah.
Thank you. Thank you so much, sir, for that insight about the global oil and gas, how the color is in the global forum. So I would now request Ashish sir if he can explain to us the value chain of oil and gas sector in brief, sir, please.
Yeah, absolutely, Sujaya. So when you look at oil and gas, I mean, as a sector, it is a huge sector, and therefore, traditionally, this sector has been looked from as two segments. The first segment is the upstream sector, as it is called, and this involves the exploration and production of hydrocarbons, and then the downstream sector, which Vineet mentioned. So that involves your refining and marketing and distribution of petroleum products. Now, as far as the upstream sector goes, historically, the conventional sources of production has been the onshore and offshore oil and gas fields. With the improvement in technology, we saw deep water and ultra deep water, blocks coming up and producing hydrocarbons. But in last few years, what we see is a lot of unconventional sources which has come up and provided a lot of avenues for production of hydrocarbons. So like shale gas in US has been proved to be commercially viable. Perhaps nobody would have thought about it 10 years back, but now it's a reality. Countries like India are trying to develop CBM, that is coal methane. We will see where it takes us, but that's the trajectory that we want to go to. Countries like Canada, Venezuela have oil sands, which they would like to obviously monetize on at some point in time. Apart from that, you have, gas to liquids, which is again a new frontier. The technology has been proved viable, but we will see, how it develops in the course of future. So hydrocarbons upstream space is something which has, traditionally been the bedrock of the energy sector, and obviously is going through a lot of technological changes because of the innovations that we see. Coming to the downstream side, from an Indian perspective, I think it's important to understand As Vineet mentioned, India is the third largest energy consuming country in the world. We are also the fourth largest refiner in the world with a capacity of almost 250 million tons. So that's a huge refining capacity that we have. Now, in terms of the value chain, traditionally the refining end has been the sort of a forward integration for the upstream space, and that could be the value drivers could be for various reasons. One could be for the securing market. If somebody is putting billions of dollars into the upstream space, would obviously need assurance on the market. The other one would be maximization of profits or value. So traditionally, when the crude is on the low side, the refining margins help the upstream sector to ride the tide. So an integrated play in oil and gas in both upstream and downstream is usually considered to be a very robust approach to manage the oil and gas sector. And linking back to the point which I started, that it is a highly capital intensive sector, and therefore in that sense, it really makes sense to have an integrated value chain in this sector. So that's by and large, I would like to talk about the value chain in the oil and gas sector.
Thank you so much, sir, for that brief and precise brief about the value chain of oil and gas sector. So now, as we are aware, and Raj sir, you've already mentioned at the outset that we are in the unprecedented times. And so what would be the probable strategies to mitigate the challenges that are thrown by COVID-19 on our industry, on the oil and gas industry?
Thanks, Sujaya. I mean, if you introspect in the history, you will see whenever there is unprecedented time, innovation always takes the front seat. And I think all the corporates are actively thinking for innovation. I mean, one of the such strategy would be oil to chemicals. Even previously, when crude was refined, the industry used to try to manufacture more gas oil, gasoline, and etc., and less of oils used for petrochemicals. But now, with the petrochemicals being the savior of the day, people will try and tinker with the technology, do some innovation so that they can produce more of chemicals for petrochemicals, because petrochemicals demands are rising, and possibly there's a chance that there will be a degrowth, or at least a restriction or a cap in the demand of the gasoline and the gas oil. So that tinkering of the product is one thing that definitely going to happen. Lot of the companies are looking into renewable energy, green energy, solar, etc. So that those diversifications and those things will definitely will be the way that the world will follow. Strange but true. In this kind of situation, when there is cost cut and cost reduction everywhere, one area is there where there is increase in expenditure, that is automation. Yes, at this point of time, cities will spend more on automation to reduce the cost, employee cost, and to reduce the operation cost. So that will be another order of day. Work from home is here to stay. So employees and employee both will leverage that. Employer will have reduced rental expenses, and employee have the savings of coming from time as well as money from coming and going to office. That will be huge savings from that time point of view. So manpower optimization and optimization of production process, including innovations, will be the thing that the industry will follow.
Great, sir. Thank you so much. So the main focus, what would be the main focus of the entities? So if you can just brush us through that again.
It depends on the entity to entity. Like in Reliance has follows a policy or take a strategy of oil to chemicals. I mean, our chairman in his various speeches and in literature, we have already stated that. So we are trying to maximum oil from chemicals. That is one of our strategy. Innovation is definitely there. It is always in the front seat. We try to innovate our products. We try to innovate our processes to optimize the yield and minimize the cost. And then cost control and cost saving is also on the forefront in this kind of times. So these are the three-pronged strategies that I think the industry will take.
Absolutely, sir. And would also like Vineet sir to let us know. So, would the retail industry get back to the pre-COVID? Is it back to the pre-COVID growth?
You're mute, Vineet.
Vineet, sir, you're on mute. Yeah.
Is that okay now? Yeah, I think right timing, Sujaya,
Yes.
because Raj and Ashish has made my question a bit simple. So COVID-19 had multiple impacts for the sector, from falling oil prices, demand going down, increasing operational cost, workforce challenge, not able to get the right people, supply constraints, liquidity crunch. I think, but the industry has really rebounded substantially, and given its essential and the indispensable nature. We even saw fuel prices going, I think Raj also touched about it, we also saw fuel pricing going even below zero for some of the future contracts. So September petrol sales were up and almost in line compared to the last year ago for the industry. And one of the biggest reason is the preference which the consumer shows in terms of personal mobility. As lockdown restrictions are eased, India's fuel demand in September rose for the first time since June, and the month-on-month increase was about 7.2%. However, there is still a weakness in terms of demand. So, as we know, during the year, there has been many more new retail sites which has come up. So it is very difficult to look for a real like-for-like, growth. Now, key reasons again could be because of personal mobility. The demand goes up, and people are preferring to have their own vehicles and go to office. That is one. Some of the industries like pharma, FMCG are doing well and they are pushing the demand up. However, some sectors are still recovering. So I think overall the industry has really rebounded substantially and it continues to be improving month on month.
Great, sir. Thank you for that. And would also like Raj sir again, since you touched upon the challenges, what do you think the future would be like post-COVID in the oil and gas industry?
Fortunately and fortunately, God has never built a tunnel where there is no light at the end. Okay, so there is the end of this. There is light at the end of this tunnel also. Demand will pick up. Vaccines are supposed to be expected to be there in June, maybe early June or April or in that period. So as soon as vaccines are up and hard mobility etc. there, so I mean the COVID will be under control. It may be there for some time. It will be under control. So demand will definitely pick up. But as per the estimates of experts, that demand may not be 100% to the pre-COVID level, but it definitely be on 80, 85, or 90% of the pre-COVID level. The demand will pick up. If you see the 16 key economic indicators that Government of India publishes, around 8 are already in green. The PMI data is very encouraging. GST collection was 95,000 crores in the month of September, and I think 110,000 in this month of October. So it is very good. It is higher by YOY figure also. UA bills are on the higher side, utility consumption higher side, cards is higher side. So a lot of turnaround we can see already in the indications are there. Things will we are moving out of the bad times, and yes, good times are ahead of us. That work from home, in my opinion, is there to stay. A lot of entities Tatas have already stated, other entities have also stated. So work from home will be there. So travel will definitely be less. But again, as Vineet told, I agree with him that that people will maybe like to travel with their own space than use public transport. So I mean that might consume that might compensate to an extent, but safely we can conservatively we can say that there will be a permanent mark in the consumption basket. Maybe it's 5% or 10% or whatever be that has to be seen. If you speak of economists, they will speak of very huge letters, B, U, Z. These letters are all explained or stated to explain the recovery. V is a very fast or shape curve, right? U is a slightly prolonged recovery, and Z is the recovery where certain industries will move at different paces. I think, in my personal opinion, it will be Z shape because industries like hospitality and aviation will some time to take to back up and to reach the pre-COVID levels, where other industries will be fairly faster than them. There will be a strategic mix. Corporates are already thinking of strategy. They will have a strategy whether to call the employees in office, whether to release their leases that they have. of their offices, etc., etc. Employees also will think whether they want to stay in a city like Bombay and work in house, or they move to a hometown and work. That will be also good important strategy for the employees. I mean, you save on cost, you move to remote places and work. So if you don't come to office, it doesn't mean so office space demand will fall. So that has some implications. But overall basis, I mean, it is fair to tell there will be a strong rebound. There has to be a strong rebound. In fact, today when the people were eyebrows were up at -24% contraction of GDP, I'm sure in next quarter, first quarter, it will be at least 18%, 17% up. So people will be very happy. People time to rejoice, but people should understand this will more be of on account of base effect. So the challenges of next year Q1, what is the situation? If there's a growth from on 20 to 21, 22 also, so then I mean we have time to rejoice. So my thing is that situation will be back.
Very
it might take some time.
Approach, yes.
Yeah.
So please, yes, a very optimistic approach, viewpoint, sir. Thanks for that. I would also want to state at this point of time a very cliched economic thesis that stands in these situations. The big becomes stronger and the small perishes. And with global oil benchmark indices like trading below, as you mentioned earlier, $40 per barrel. Maqbool sir, I would like you to comment on this because you're in the upstream, we want your views in the upstream. So many upstream oil companies are facing existential crisis. US shell industry to begin with. So do you think there is massive consolidation is inevitable in this in the global oil industry? Maqbool sir, please.
I think yes, definitely. I mean, in fact, if we look back a little bit, this decline and the crisis in the oil and gas industry is not just new now. We had it earlier on. I think in 2008 there was one. 2014 was quite remarkable period because the consolidation, in my view, actually started then. Pre 2014, and when the oil prices were very high, many individual small investors got into the exploration and field development business around the world. In 2014, when prices went down and the crisis came in, many of them just had to sort of give in. There were a lot of bankruptcies, and they just scanned out. Currently, I think again we are going through a similar phase. Of course, this time probably there are not too many of the smaller, businesses which are around. But the second tier, I think the medium, the private equity type of businesses, they will be under quite a bit of pressure, and then quite a bit of challenge will come into them. Now, whether it's a good thing or bad thing, I think it can be even a better thing for many, because that would basically mean that when they go bankrupt with heavy sort of debts and interest costs, good thing is most of them are limited liability, or those sort of companies. When they go bankrupt, the investors just don't lose very much other than what they have invested. The main people or the institutions who suffer are the lenders, but that is for them. On the other hand, most of those assets will come in the market at a very, very cheap price, because these are the businesses which have assets which have gone bankrupt, and given the market situation, there won't be many buyers. So some of the larger or the new investors may jump in, and they may buy these bankrupted assets at a very, very cheap price without any debt burden with them, and so on and so forth, and might create an opportunity for them to get into the business with very limited heavy investment. Ashish in the beginning mentioned
Absolutely,
that
oil and gas.
Sorry, Ashish in the beginning mentioned that. Sorry, go on.
Sorry, sir. Please go ahead. Please go ahead.
What I was going to make the last comment, that Ashish in the beginning mentioned that oil and gas is quite capital intensive business, and one of the reasons is the whole life cycle is quite long. So with this sort of a consolidation, opportunities will come for the new investors to come in and get into the business. So definitely
Absolutely.
Consolidation will be there, but it will create more opportunities. Yeah.
Agreed, sir. Thank you so much, sir, for that insight on the consolidation. Now I would also like Ashish sir to throw some light on what are the major sectoral reforms in India in the recent past and why India is still largely import dependent, sir.
Sure. So, if you look at the policy framework in India in last couple of years, I think a lot of ground has been covered. If you look at the upstream sector, you have now something called as HELP, which is the Hydrocarbon Exploration Licensing Policy. So this replaces the earlier NELP policy. So the key changes which were brought in were the shift on the concessionary agreements from production sharing contracts, which were essentially cost recovery model, to revenue sharing model. I think that fundamentally changes the landscape of the upstream sector in India. Along with that, you have the open acreage licensing policy, which has been brought up. So this now allows the investors or the explorers to carve out the acreages that they find relevant, and then they can go and submit their bid proposals to the regulator on tab basis. Practically, it means that any time of the year. Earlier during the NELP rounds, if there used to be these bidding rounds once in a year, where the government used to bundle up these acreages and offer. Some of them were inefficient, some of them really didn't make sense, and therefore that really didn't attract too much of interest among the exploring community. So this is one side of the policy frameworks that we've seen, which has seen major changes. The other side has been in relation to the marketing and pricing of gas. So there have been some more relaxations in the marketing and pricing of gas from the deep water or the ultra deep water blocks, or for that matter from CBM, which really improves the flexibility in terms of the commercial viability of those investments. We also have seen setting up of a new trading exchange for gas in India. So this basically is not for the domestic gas, but is for the import gas. So now sellers can actually market their gas on the spot and forward markets to the Indian buyers in this exchange, which I think is a great step in institutionalizing the gas market in the country. The other piece, if you look at the downstream side, there is, which we mentioned, that the private participation has now been allowed in the retail distribution of the transportation fuels, that is petrol and diesel. So this will definitely broad base the marketing and distribution of the petroleum products in the country. So I think these are the major changes that we've seen in the policy frameworks in the country. Uh, Coming back to the question of why India is and will India continue to be import dependent. Now, I think
Yes, sir.
it's a combination of several factors. It's not that India did not attract in the interest of the international oil and gas companies. I think almost all of them came into India, but unfortunately, the policy framework was not that matured or was not able to manage the expectations of those stakeholders. And now that when we have these changes coming up, which is far more globalized, you find the oil market has predominantly been depressed since that point in time. On a relative scale, you would find other geographies with a far better reservoir profile
Infrastructure.
and much better commercial terms. Yes, far more competitive than Indian sort of play. So we still have Bombay High and the West Coast as the largest field, and we have not been able to repeat that feat in such a large country and with such large reservoir base. So given the kind of refining capacity that we have, I personally don't think that there is going to be a significant shift in terms of the import requirements. We will continue to import majority of our requirement, and hopefully we will see that the unconventional sources helps us to reduce a little bit in terms of the gap.
Agreed, sir. And thank you so much for bringing to us those reforms in in couple of minutes. You have brushed through so many reforms. Thank you so much for that, sir. I would like Vineet sir now to let us know if a few like what should a future retailer consider while setting up retail outlets?
Sure, I think thanks. So I think let us see some changing trends. I think the consumer needs are changing, providing additional services like shop and to have some other kind of an income from the retail side, technology, distribution of fuels, and the viability obviously there. So future retailers should consider modernizing the consumer experience by offering fuels as well as convenience shopping, providing additional services like electric charges, could be just one of them. Even addressing the future needs, such as what should a consumer do while he's waiting for his car to be charged. Maybe I'll touch upon distribution also. So distribution network for India is quite large in terms of 5.5 million kilometers. And there has been good improvement in terms of roads, but however, it still remains a risk in terms of road transport because fuel has to reach the end consumer. So now, slow and steady, we are moving towards, bigger, better, faster, trucks and tankers. Tankers are, unfortunately, the 70-75% are still being fabricated by the unorganized sector. I think there is a big shift, coming as a change here. Now, let me also touch upon EV. I'll take a minute more one. So let me also touch upon EV. I think EV is still, area which is coming up. However, there is still a demand coming up for EV, but at the same time, the need for the conventional fuel is still growing. So the difference and others has to be still filled in by the normal oil and gas. Maybe a last line also. If I take some examples from outside the,
Till the
outside
prices
India.
of the battery are reduced. So I think till the battery prices are reduced and they find, it is equivalent to the gasoline prices. So oil and gas industry can still sustain during those time till that time. So
That is one, and even the differential demand. The demand is still so high, and maybe the last line also, as if I look at some of the international trends, BP and others are having some kind of a partnership with FF, like it could be companies from the FMG sector. So they had a partnership with Marks and Spencer in UK. So I think those kind of trends will also come in future.
right, sir. Agreed, sir. Ashish, I'll be back to you again. If you can let us know some of the significance with your experience in the risk. So if you can let us know some of the significant risk in the industry, sir.
Yeah, sure, Sujaya. So I think this is quite an interesting question. So, I mean, if you look at the the amount of money which goes into the oil and gas sector annually in exploration and production, it will be close to, I may be not very accurate, but close to 500 to 600 billion US dollars. Now, what is the what is the success rate of finding an hydrocarbon? The international average is around 30 to 35%. Now, that's the global average. Obviously, for individual companies, it may differ. Now, what does that mean? I mean, if you look at it at a very broad basis, it means that almost 70% of that capital has to be written off. So that's a huge amount of money, which you really don't have ability to recover. But that's the kind of profile of oil and gas that we have. So that's one aspect. The other one is, how even if you are able to reach to the stage of proven or probable reserves, building field development plan to commercial viability is another challenge by itself. Now we've seen how the geopolitical risks impact the oil prices. Raj very in a detailed way articulated how the crude has moved, how the cracks have moved. We had negative GRMs. So just imagine, a company in oil and gas who starts the exploration, 3 years, 4 years down the line, builds up the, develops the field and brings the hydrocarbon on stream, has no visibility of what the crude trajectory will be at that point in time. So it's a huge risk that one has to take in relation to making the investments successful in oil and gas sector. The other dimension is the regulatory aspect. So obviously, crude prices would continue to remain volatile, but then the challenges also come from the regulatory end. If you talk of country like India, there is no assurance to any investor as to what will be the fiscal regime, 3 years, 4 years down the line. So what would be your indirect taxes? What would be your direct taxes? What would be the special taxes for oil and gas sector? There's very difficult scenario to build. Likewise, governments have ability to arbitrarily change the concessionary agreements, change the commercial terms, which may completely make your hydrocarbon, commercially unviable to produce. Now, if you just look at the domestic gas being produced from the nomination blocks, the price at which they are able to sell is close to $1.79 per MMBTU. Now, you tell me how anybody can really find that commercially viable. Though yes, the counter argument would be that yes, there are few concessions given or relaxations given rather for the other fields which are coming under help. But at the end of the day, the crude oil is still not freed. So just imagine if you invest in an oil and gas venture, you have perhaps ability to price or market your gas, but you have absolutely no freedom to market your crude. So to that extent, still there is a long way to go in terms of managing these systemic and fundamental risks that you see, which comes in the way of making our oil and gas industry more broad-based. The other side of it is obviously, the technology and the people side. So though yes, we can feel good about the fact that India is the fourth largest, has the fourth largest refining capacity in the world, the fact remains that we are heavily dependent on outside countries for technology and technical expertise even today. I would say completely on the upstream side and to a very large extent on the downstream side. So therefore, it also poses its own set of challenges and risks. Uh, if we look at the refining side or the downstream side of the business, then obviously we talked about the crude prices, but obviously there are also risks regarding availability of crude. Now, given the fact that we are largely dependent on imports, availability of crude is a major concern. Now, traditionally, India had relied on geographies like Iraq or Iran, Venezuela to provide heavy crude. But now, because of the sanctions or the troubles in Iraq, these traditional sources of supply have become challenged. So finding a viable source for crude supply is another challenge that you see in the downstream sector of the business. Likewise, currency volatility is another major factor that impacts the operations of the GRMs. So if we're importing almost entire crude and a major part of our product basket is exports, there is a huge exposure on currency volatility. And when you have such scenarios like COVID, it really impacts the whole projections in terms of your currency assumptions. One could say that yes, you have a natural hedge if you are also, a significant part of product is exported, but then the timing becomes really important over there. If you are not able to time it right, then that would create a huge impact on the GRMs. So these are the few, risk areas that I just wanted to discuss. There, it doesn't mean that these are the only risks in oil and gas sector, but these are perhaps some of the more prominent ones. Yeah.
Absolutely, sir. Absolutely. And I would also like Raj sir to throw some light. If you can share your thoughts, sir, on what are the significant risks.
Thanks, Sujaya. Sujaya. Actually, I see a risk of disruption. In my opinion, disruption is inevitable. I beg to differ if others have different opinion, but in my opinion, disruption is inevitable. In year 2000, I brought an analog camera, and at that year itself, someone told me something called digital camera, and after 4 years, analog cameras are there out, and digital cameras were there, and then it came mobile. So things happen very fast, even faster than we think. So like Vineet told, I completely agree with you that we have to tinker on a business model. So if you're pump in the highway, you should give a consumer experience. You should have a small mall sort of things. You have, like, we airlines are going out to the EV charging facility. You should go out other facilities for the consumers, and you have to think what the consumer will be doing when the vehicles is getting charged or the vehicle is filled. So all these things are there. So this disruption, I think, is definitely there. In Reliance, how we have managed this, if you process crude, at the end you get some off gases and you get some coke. Coke is the last straw of the material that you get, and it is very is a less valuable product. But we have set up a cracker, gas cracker, wherein we use that off gases to crack and get ethylene propylene, which is a building block for petrochemical high. So we convert it to highly valuable products. And coke, we have done coke gasification, so we can gasify coke to generate syngas, which will replace LNG. So this is huge measures of cost saving. So this kind of efforts are required, or industry has to take a rate. Otherwise, there is a chance of disruption. Excess production saddled with sack demand. Marginal players will find it difficult. Only cost-efficient players will exist. Others will close out. In Europe and US, there are a lot of petrochemical players where crackers operate only in certain part of the year and they're closed. Otherwise, this kind of scenario will be there. They will not be able to operate 12 months a year. So again, innovation will be a front stage. I mean, that would be the key that the industry will be addressing at this point of time.
Thank you so much. There's so many inputs coming in. I'm keeping an eye on time as well. Sorry if I'm cutting you all midway, but like I'm really getting a lot to learn. But I'm also keeping an eye on the time. So thank you, Raj sir, for that great insight. Your point of view on the risk, on the significant risk, and how Reliance is actually trying and turning it around. So also I would like Maqbool sir, if you can let us know, so oil industry which can generate huge wealth for a country, it requires significant initial investment, like you were telling sometime earlier, with high risk of failure. There is initial investment with high risk of failure before a country can actually reap the benefits. So what makes it so investment intensive and risky? So can you just give us a brief overview of the entire investment process before one can get assured of success? Maqbool sir.
Yeah, sure. I think fortunately, I mean, okay, we have a time constraint. So fortunately, Mr. Ashish covered some of the aspects of the process, which sort of indicate the risky elements in the whole process. Also on the downstream, Mr. Raj mentioned. So what I'll try to do is, without repeating much of what's already been said, very briefly indicate why, I mean, this whole process is so tedious. Ashish did mention something about exploration. I think the process even starts before that. The first process is, I mean, every country probably looking at, not at present, but about 15, 20 years ago, was looking for somebody to come and do some exploration work in their country. But the degree of risk involved in this business, like a 30% success factor, is still quite positive. It could be even worse. So whoever wants to come into the business has to first make sure that the country which is inviting has some prospect. So they look around the region. Gulf is blessed. So I think it was not so difficult for Oman to attract in the early 1930s when somebody came in. And the first step is to go ahead and do the seismic service, which again is very, very tedious and expensive, especially going to the remote areas and trying to see whether those areas have some oil. They have to do some work now. Okay, the technology helps them to identify whether there are liquids underground. And it's itself quite a process to hammer some heavy blocks on the ground and pick up the seismic waves and then assess whether it's water or gas or oil. And when they find a gas, then the second step that starts is doing some exploration, seismic and then exploration, which again is very expensive. Exploration wells are basically taking a huge rigs on site and then drilling holes to see whether they can touch the oil. Many times they fail. And all these processes are very, very expensive. Once there is a success, 30% or less of the number of drills that, drilling rigs go and do the drilling, then they go into sort of a, appraisal phase where they have to sort of drill many holes around, wells around to see how big the field is. Many times they find that there's not very big and then just have to take the losses and go away. And the next step then comes in when the appraisal shows just there's a sizable field. They do a lot of testing to see whether there's economical. Are they economically sound to go and invest more. Now, all these things are very extensive in investment, but the end result, when you go into field development and transportation, it's itself is a very huge sort of an investment. So one has to be very, very careful how all these appraisals and testing and economic valuation takes place. All these phases, if they are success, then they go and do the field development plan. They set up the camps and for offices and accommodation, and then with different kind of equipment to process the liquid that are coming in. They are sometimes mixed with gas, sometimes they are with sour gas, which can be very dangerous. Other times they are mixed with water, how to separate them. And once that is done, then the transportation. In Oman, the transportation is done through pipelines to a oil terminal from central Oman, which is quite arid and deserted area. That the heavy investment in the pipelines until you get to the terminal and export it. Now, it does normally take from seismic when somebody comes in until you start exporting or selling the oil between 7 to 12 years. And in each year, you have to have a very heavy investment. It's not very unusual that the initial investor who started the process by the end is not even there. He might have either gone bankrupt, somebody else might have picked it up. But what is often happens that during this process, a lot of newcomers come in. So when there's a first first success, seismic or exploration, new investor coming to help because the guy is already struggling. And as the success becomes more closer, more investors come in because the risk gets lower. And that in itself is a quite a tedious process. I think I can just only say this, that it's really, takes when somebody goes in, it has to have a very deep pocket to bring in the funds to make sure that at least first phase is successful. Initial drilling, initial seismic work, and once he's successful, then he says, okay, I can bring few investors. This is in a nutshell the whole process, very lengthy. Once you put in the money, it may take maybe 10 years, 12 years before you can see any return. Ashish, perhaps you can, see if I have missed anything.
No, sir. You have actually very nicely covered the entire, gambit of the exploration to production, and of course, we hope that the unconventionals will play also a big role. But yes, in terms of capital allocation, still the conventional exploration still occupies the major share. So obviously, we will see the same sort of challenges in next 10, 15 years continued. Yeah.
Technology is helping. I think it's been quite a tremendous in terms of recovery. There was a time when you find an oil, you were lucky if you can recover 50% of oil you find. That is now increasing with the technology to 70%, 80%, and that's helping a lot. Sorry, that's about it.
Thank you so much, Maqbool sir. I think the process that you told us in a nutshell. So the process is not that simple, definitely, but it sounded like you have explained it beautifully. I would like Vineet sir, to let us know how has digitization affected the fuel retail industry. So a quick note on that if you want to touch upon.
Sure. Maybe I'm moving towards the banking and the payment landscape. So over the years, I think fuel retailing has been a cash market, maybe about 90% of the transactions were cash. But now is the time when the movement from cash to digital for the Indian consumer has started. The COVID, and also there are multiple initiatives from the government has supported. Today, I think as we stand, approximately about 35% of the total fuel transactions done at the retail sites for the industry have now moved to cashless. And it's a big move from 10% to almost like 35%. And the data really moves by different state. So every state could have a different data. It is basically a journey. We are all on this journey. Mobile wallets, app-based payments have all been really helpful. Maybe touching on digital fueling initiatives, I think there have been multiple, probably all retailing companies have been looking at how we can provide 100% reliance, in terms of quality and the quantity of fuel. Maybe I'll just take two small examples. So maybe again in terms of payment, the radio frequency identification, which is RFID. I think if the chip is embedded in items at the forecourt store, it could potentially lead to an entire basket being scanned in one go and reduce the time for the consumer, which is there for checkout. So I think those are the future trends which are really
we'll be
coming up.
having in fuel as well. Yes, sir. So fuel retail will be seeing that move as well.
Yeah, definitely. I think those are the changes which will come in the fuel retail.
Great, sir. So one more point you would you wanted to speak on 2 points. Haven't you done so?
Yeah, maybe I think also in terms of the entire now there are moves that the fuels can be reached at the consumers. Let's say for example, if the buses are parked, why does the fuel station be there at one point? Can the fuel station not reaches where the buses are parked and basically fill the entire buses? I think delivery of fuel at the doorstep is also starting up.
Okay, great. That was a good insight, sir, from you. Ashish sir, I would get back to you on, like with most of the oil and gas majors announcing their targets for net zero carbon footprint, will hydrocarbon continue to remain relevant in the future? So your thoughts?
Yeah, I mean it's quite an interesting topic of discussion, right? Because carbon emissions is something that everybody is looking at seriously, whether it's the oil and gas sector within, or even countries and companies outside oil and gas space. Now, the way I look at it is perhaps from a different perspective. That today, as we speak, almost 1.9 billion people in the world are below the poverty line. Now, the only way we can bring them to prosperity is to provide them with some form of energy, solutions. We have, I think, 190 plus countries globally, and we have maybe just less than 10% as developed economies. So if more than 90% of the countries worldwide have to grow towards development, there will be a requirement of some sort of energy. Now, currently, as we speak, it's only the hydrocarbon or the traditional oil and gas which provides the viable solution. I'm not saying that the new forms of energy, the renewable sources, are not relevant or important, but we are talking of the sustainability or the viability of oil and gas going forward. So I definitely feel that oil and gas will continue to remain very relevant and prominent part of the energy mix, even in the foreseeable future. So that's, I think, very well settled. Now, coming to the emission targets, so I feel that these are like not absolute, target. These are net ambitions. These are not commitments. And then when you look at the net emissions, what it essentially means is not cutting down the production of hydrocarbons, but setting it off with slowly and steadily changing the product slate of the of the offering. So which Raj was mentioning, that yes, there is a disruption, but the disruption is not just for the immediate requirement to manage COVID pandemic or things like that, but the product slate is changing towards longer term sustainability also. So therefore, you find solutions like gas to liquid, or you find biofuels. Now, the new frontier is hydrogen, that is the gray hydrogen, and I believe that that is something which definitely will see a lot of action in the next decade or so. Though yes, there is a possibility of green hydrogen also, and there are a lot of investments happening, especially in Europe, for that. But at least for next 2-3 decades, the gray hydrogen is going to remain cost efficient. So I think to sum up my point, I would say that yes, both societies and the corporations are inching towards emission norms, but at the same time, it has to be balanced with the economic growth and prosperity of people. And in that sense, of course, hydrocarbon is going to remain prominent and relevant even in the future.
Agreed, sir.
The product slate will, of course, change. It will evolve with technological disruptions, but
Yes.
the requirement of energy will remain and continue to remain for hydrocarbons.
Thank you, sir. Raj, sir, your thoughts, please. We are running actually out of time. So Raj sir, your thoughts, please.
Thanks, Sujaya. I'll conclude this in 2 seconds. I agree with Ashish on this. I mean, whether oil and gas industry will remain relevant and pertinent, answer is yes. Being a corporate citizen, not only oil and gas, all industry have responsibility of running or meeting the target of zero carbon footprint. It doesn't mean that you will not generate. It means you will generate, you will emit, but you will try to reduce it, and then you negate it with somewhere, so that on totality basis it was net. I mean, all the industry, irrespective of hydrocarbon or oil and gas or etc., will being a corporate responsibility and citizenship, they will move towards that. But yes, at the same time, I personally believe, with lot of talks being battery operated car, etc., I think this industry will be relevant and pertinent years to come. Maybe smaller vehicles may become EV or battery operated at some point of time, but larger vehicles, I see a long road ahead. So this industry will definitely be there, and being a part of corporate citizenship, the industry will move towards zero carbon footprint. This is my take as far as this.
Thank you so much. So I'll skip one or two questions, and I'll move to the last question. So what is the role of finance professionals? So that would, I think the participants would be interested to know. So what role they can play in this sector? To start with, Maqbool sir, if you can please share your thoughts.
Well, I think finance professionals always have a role in terms of contributing, although many people don't see that. I mean, I try to summarize when the critics come into and say, what is the finance doing? They are overhead, they are not helping produce something. My response to them is basically finance, yes, they are not like normal bits. I mean, to take an example of a human being, we don't have hands, so we don't produce anything, we don't walk, we don't transport anything, but we are the engine like blood, which circulates. So a good finance man can always allow all the parts of the business to know how they are faring against financial aspects of the business toward the financial target, whether it's transportation, whether it's sales, whether it's production, whether it's storage. And a good finance person would be in a position to make sure that all that segments are covered properly, analyzed properly, and are really contributing towards the bottom line of the company. If they can do that, I think they will make sure that the management is always keeping in sight not just the technical and other aspects of the business, but the financial aspect, which really is the key to the shareholders. That's what I would say, the role they can play.
Thank you, sir. Vineet sir, your thoughts, please.
Maybe I will not repeat.
On
I will
what
just
role?
add only. Yeah, maybe I will not repeat. I will only add only the few things here. So I think the industry is quite regulated and bound by several rules and regulations and tax laws. A sound finance professional can easily understand and and can be thorough with the rules and the key role which a finance professional will play will be mainly in terms of the investment decision and the viability of the projects. Investments are still coming in. I think this sector is still growing. So there is a key role for finance to play here.
True.
Sure. So Ashish sir, your thoughts, please.
Sure. So just to quickly add what the co-panelists have said. So oil and gas industry has its own accounting board, which is called COPAS. That is the Petroleum Accountants Society, and I think the finance professionals, once they understand the accounting treatments of oil and gas, especially the upstream side, exploration side, that really gives them a lot of core competency to develop their careers, not just in India but globally. As Vineet mentioned, there are a lot of opportunities on the investment evaluation and also value protection in terms of how those projects materialize. This sector has a lot of joint ventures. I think perhaps the only sector which has the largest number of joint ventures, where again finance professionals can play a lot of responsibilities in terms of governance and in terms of risk mitigations and audit reviews. So I believe the sector provides immense opportunities for finance professionals to add value.
Raj sir, your thoughts? I can see Murtuza sir there.
So I'll be making a statement, and sorry for that. I feel accountants are all dead. And yet they will have a dominant and responsible role. So this is self-contradictory, but let me explain my statement. Accountants, what they used to do 20 years back or 10 years back, I think if they keep on doing that, they will have no role to play in the age of digitization, automation. Things will be automated. But accountants will have a very important and dominant and responsible role in the organization, because they are practically the goalkeeper and the conscious keeper of the entity. If you see the accounts of September and June, you will see BP, Shell, and Exxon has announced a huge impairment of 17 billion, 20 billion, or 30 range of that 30 billion. So the accountants have definitely played a role in being a conscious keeper, and they have cleaned up the balance sheet when there was an opportunity. So accountants are, like I think Ashish or Vineet have told, that accountants will move on to the additional role of accounting. It will be left to the ERPs and softwares, but they will be more into judgment. They will more into monitoring. They're more into a role of responsibility and governance. So that is what the future of the accountants are there.
Thank you so much, Raj sir, for that insight. Murtuza sir, do we take questions, or how do we move, sir?
Yes. So questions are here. Sujaya, you want to read, or should I read them? I'll also request Anuj and Anand to join us. Anuj, the first question is again on tax. Anuj, if you can switch on your camera and come across. So in the meanwhile, let me take the third question. If panel can touch upon oil politics involving OPEC, Russia and US. Anyone wants to take that? Mr. Maqbool?
Yeah, right person.
I was hoping you won't call upon me. Very easy and very difficult question. I think any time there is any commodity which has global economic value, politics creeps in. And unfortunately, economics are playing such a significant role in today's world that the more you have, the more you are targeted. So OPEC is under pressure. Russia is under pressure. Of course, Americans, they have recently gone into net producers and exporters. They are becoming targets as well from environmentalists, from various bodies. So that will always be part of it. Now, how these countries manage that, I think, will depend on their strength, and not just oil-related, strength, but other aspects, whether they can fend off undue pressures on themselves. Oman being a smaller country relatively in terms of producing the oil, we do sometimes get the pressure, but alhamdulillah, God willing, we have been able to deal with such pressures from various parts and maintain our political neutrality. Our Sultan Qabu, may God bless his soul, and the new Sultan, His Majesty Haitham, is continuing to see how we can have a balanced role and maintain positive relations with everybody around us, especially, as well as around the world. And yeah, that's my take on it. Yeah, politics will always come in. We can't just get rid of it.
Thank you, sir. Thank you for covering that quite well. So the next two questions are specific. Question to Vineet: future of fuel delivery startups in India. Vineet.
Yeah, thanks, Murtuza. I think this is probably a very good question in terms of, because we don't know. I think what is important is the safety and security. If everybody starts running on the road with the fuel, obviously it will not work out. But as long as it is done into a safe, safety, security, that the transport is taken care, I think this is a very good idea. The example which I took, if the buses are parked somewhere, why do they all need to come and queue up to basically fuel up? Can the fuel station not go go near them when they are parked, when they're quietly parked in the night? Just fuel them up. Tomorrow morning they're ready. So I think it all depends, but everybody can't start run with the basically with the fuel. Another one more example could be all the housing societies needs they would need diesel, and most of them are basically running on rickshaws and getting diesel. that can be automated by those maybe apps or the fuel delivery, as long as they are again with the high standards. So I think fuel delivery is there in multiple countries. It is a future as long as it can be done safely.
Thank you, Vineet. I think quite well covered. Ashish, the next question specifically to you, question to Ashish. Being a capital intensive business, for exploring companies, what can be taken as a break-even price of crude for the companies to keep running the operation?
Sure. So I think a large part of the break-even price would depend upon what is the which part or which geography are you talking about, and what is the conventional field, whether it's a deep water block, whether it's onshore block, because your exploration cost can significantly vary. You can get a rig of say $1 million a day, and onshore rigs would come at perhaps tenth of the price. So it's very difficult to say that what would be the economics look like for various exploration plays. But just just a rule of thumb, if it is so that generally the $40 price is considered to be quite a good benchmark in terms of the viability of oil and gas sector as a whole. So where you find crude inching below $40 a barrel, that's the time when it becomes very uncomfortable for most of the oil and gas companies to continue with their run rates and investments. But as I said, it's very difficult to put a number in terms of break-even because it largely depends upon what kind of exploration play are you looking for.
Thank you, Ashish. Thank you. I also thank Anand and Anuj both for staying on till the end. And Anuj, two direct tax questions. So I'm coming to you, you being an expert today. So the first one, Anuj, if an assessee exercises for concessional tax regime under 115 BAA of the Act, then whether claim of expenditure for site restoration and permanently lost, or we can claim the same under Section 37 of the Act in the year in which provision towards site restoration expenses is made on scientific basis, okay, as revenue expenditure.
Yeah. So I think this is connected to the question that was raised earlier, and maybe my short answer is so once a taxpayer makes election to this special corporate tax regime of 22% under 115 BAA, then there is a specific carve out that any expense referred to in section 33 ABA is not to be allowed. And 33 ABA is the section that deals with deduction for expenses or amounts contributed to the site restoration fund. So once the election is made to 115 BAA, then deductibility under section 33 ABA relating to site restoration expenses is likely to be not allowed. And now the question is, if it is not allowed under 33 ABA, then can the deduction be claimed under section 37, which is really a residuary section for claiming deduction? I think answer to me should be no, because you cannot cherry pick and say that if an expense is not allowed under one particular provision, you go to other provision. I think the rules of specific provision overriding the general provision will apply here. 33 ABA being more specific provision should override 37, and expense should not be allowed when one were to read or when a taxpayer elects for 115 BAA. So answer is no for question number one, and second is again connected to that. Second says where the taxpayer can claim deduction of expenditure incurred for site restoration in the year of actual incurrence. Again, I think this is linked to section 115 BAA. If election is made, answer is no, it cannot be claimed as a deduction in the year of incurrence. If the election is not made to 115 BAA, then expense can be claimed.
Thank you, Anuj. So to all the participants, if there are any further questions, please write to us at wirc@ici.in. We'll send on mail to the experts, get their answers, and we'll respond back to you. And thank you for staying on till the end. I thank Anand and Anuj for covering the first two sessions. Very well covered. I also thank Sujaya for moderating so well and getting out all the relevant inputs from all of them. Mr. Maqbool, really grateful to you for joining us and bringing us a global perspective. And I think you could talk to us about, like, completely in a country, how does a country look at in this particular industry at least. Vineet so well covered the whole retail side of it. Raj, really excellent for covering the whole refining part of it, Raj. And Ashish, whatever anyone left out, you covered everything throughout. So like multiple pieces, and I could see that internal auditor who has worked through all stages of the oil and gas and really quite well. And I also should thank Rajesh Shah being the coordinator today. Rajesh bhai, over to you for a formal vote of thanks.
So
Go
it
on.
was an excellent session, and how these 3 hours has gone, we don't know. So it was a very, very interact panel discussion. Sujaya has made everyone listen to each and every question very thoroughly, and all the panelists was very, very thorough about their subject. Thank you very much on behalf of WRC. Hearty vote of thanks to you, and thanks to Murtaza bhai to give me the chance to be part of this wonderful session. Thank you.
Thank you.
Thank you. It's been a pleasure.
Thank you all.
Thank you.
Thank you all.
Thank you. Thank you.
Thank you. Thank you, everyone.
Thank you.
Thank
Thank
you,
you.
everyone.
Cheers. Bye. Thank you.
Thank you.
Bye bye. Take care.